Yeah, Saurabh, you there?
Aditya,
Yeah.
hi, Ankur this is मैं call कर रहा था. I was saying Saurav has a presentation to make, so can you enable the screen share for him?
Yes, one sec.
And similarly, same thing for
Yeah, he's a co-host now.
perfect. Up now we can share. Okay, done. So he will share like whenever you start, no? Then in at
Yeah, yeah.
five
So
at
we'll start by 4, 5 or so. Okay, 5 minutes past 4.
so just either message me or like tell us. We'll start then.
Yeah, yeah. I'll tell you here.
Similarly, when I will also log into the same link at 4:30.
Ankur, this is live. This thing, just call.
Done. Okay. Thanks.
Yeah, hi Saurabh. You there?
Hey Aditya, hi.
Hi, good evening. So I think let's get started.
Sure.
Yeah. So you already a co-host. I will.
Do you want me to start the slides, Aditya?
No, just share your screen.
Okay.
And I will. I'll get started, and then you can take over.
Yeah.
Okay, super. So I think we have back again a very tight schedule today. So we, without taking too much time, let's get started. So audience, good evening. Welcome back after, I hope, a well-deserved weekend. I know we had a long and a very hectic schedule last entire week, back-to-back sessions on 5 days. This week again, we have a similar schedule, but I'm hoping the long weekend, which is following, I'm going to follow this week, will make up for all the hectic schedule and back-to-back knowledge sessions that we're going to have. So today we are talking about the fixed income innovation segment, and this is in a lot many ways a complete antithesis to the segments that we've done earlier. We will be talking about high risk, high return investment opportunities. Fixed income, we all know, is that calming factor in every investor's portfolio. But it's, in an interesting way, a lot of asset managers are now playing around with this particular asset class to retain its core of being a secured asset class, but at the same time bringing more diversification in terms of approach and returns. So we thought of creating this segment purely to focus on products and strategies in and around fixed income, and would like to thank InCred Alternative Investments to understand our vision and the vision of this entire program, and to come on board to present it and jointly organize it with us. So thank you, InCred Alternative Investments team, for this. Saurabh is our first speaker for the day, Saurabh Jalaria. Saurabh was also with us on the very first day of this initiative in the AIF and PMS segment. So let me quickly welcome him on the behalf of the audience and eQualify team. Saurabh, thank you for joining in again. And audience, Saurabh is the CIO of InCred Alternative Investments. He also has the SME loan business. Prior to joining InCred, Saurabh has spent over 13 years at Deutsche Bank, last as a managing director based out of Singapore, where he was lending to corporates and SME borrowers across Asia with a focus on India. So who better than Saurabh for us to kickstart this fixed income session today? And Saurabh is going to share his views on how this sector is shaping up and what are the exciting things or opportunities that are coming up in this sector, and what are the key trends that the investors should keep an eye on. So Saurabh, without further ado, I'll hand over to you. We have around 25 odd minutes for this opening session. And so if you have time towards the end, as you are aware now, I'll be happy to moderate the Q&A on behalf of the audience.
Yeah. Perfect. Thank you, Aditya, once again for having me, and good afternoon, everyone. My name is Saurabh Jalaria, and I'm going to talk about the topic which is mentioned on the slide: innovation in Indian fixed income investment. And I think the most relevant thing is what we see the innovation coming in the last few years, and which we think will multiply over the next 5 to 10 years, is emergence of closed-ended investment vehicle, which is in the form of CAT2 AIFs, of providing a very attractive investment alternative for investors. And I'll sort of go through this presentation to take you through my thoughts on the sector. So just a table of contents, but I think the first and most relevant thing is we all know India is a very underpenetrated debt market. The private debt to GDP in India is a fraction of what it is in some of the other developed markets. Couple of reasons. On the demand side, I think a lot of the debt which is borrowed by the government entities, because a lot of PSUs that conduct business in India is not part of this private debt. And second, on the supply side, again, most of the debt in India is done through balance sheets of banks that are buy and hold. And that sort of, again, reduces the amount of debt that's available compared to capital market intensive countries like UK and US, where the lenders own less than 25% of the total debt compared to India, where it's about 90-95%. Just in terms of, I think the overall within this, when we look at who are the players in India, it's very clear that almost 75% of debt that's provided to Indian corporates or household is consisting of banks, NBFCs and HFCs. Whereas the mutual funds as well as the bond market is less than 25% of the total amount of credit. So this just tells you how underpenetrated India is from the supply side on mutual funds and bonds. I think this is probably where the crux of the problem is. If you look at, it's a busy slide, but I'll sort of talk you through why our analysis is it's a good time to be a private debt investor in India. Is the banks, the large banks, the table on the right-hand side, whether it's ICICI Bank, Axis Bank, Bank of Baroda, SBI, are reporting an increase in credit that they are disseminating to borrowers that are rated A- and above, right? What does it mean is there's a flight to quality. 2018 onwards, Indian economy has had its own share of issues, first with the demon, then with GST, and then finally with COVID, and in between, if you throw in the ILFS and DHFL crisis, there's been a big change in the mindset of Indian banks. Second, if you look at on the table in the middle, banks are increasingly lending to entities which are A- and above, or to retail, right? So it's been a big barbell strategy where banks are trying to get into retail lending, but on the corporate side, sticking to the more established borrowers, right? Which is very evident from when we look at the overall credit breakup and from their own balance sheets. The second category of investors in this segment were the mutual funds. And if you just look at on table on the left-hand side, within 2019 September, right after ILFS strategy, when this was still a very prominent investment, credit funds used to be about 6% of total AUMs within the debt schemes. It's now shrunk to almost 2%, right? The largest player, Templeton, had its own share of issues, and they vacated the market and had to put up gates, and investors had some heartbreaks. But I think the most important thing is people didn't lose money. Our view is that the asset liability mismatch, or the fact that they were investing in illiquid credit investments with an open-ended mutual fund strategy, that was probably what the market is pushing back on, and hence emergence of close-ended AIFs to sort of match where the funds are lending versus the fund life itself, which is a close-ended fund. And then what it means is between 2017 and 22, just in 5 years, there's been a big change in the macro supply of credit, right? The AAA to the A+ segment, which is the 12% rating zone, I think there we haven't seen much difference. The banks, mutual funds, and NBFCs play. The extreme right-hand side, the special sits and distress, once again, not much difference. It's the foreign investors, the foreign debt investors, maybe foreign banks, and the Indian ARCs plays. The segment in between the middle, the 13 to 18%, what is called performing credit space, is where there has been the maximum change in the composition of who are players in the market. This is the A- to the single B rated segment, 13 to 18%. Small private banks, the likes of Yes Bank, the likes of RBL, the likes of IndusInd have kind of retreated to some extent within this segment. Mutual funds are virtually non-existent. Even the NBFCs that used to supply capital, the wholesale NBFCs in the country, have all pivoted towards retail lending rather than focus on wholesale lending, right? And the emergence of these close-ended AIs in the last 4 or 5 years is still a fraction of capital that they bring up compared to what has been vacated by the smaller private banks, the mutual funds, and the NBFCs. So it's really an attractive time and opportunity for AIs to play in this space, but it's been vacated in the performing credit A minus to the B, 13% to 18% kind of a range. CapEx in India is finally is picking up. If you look at the GST collections, it's been increasing, inching month on month. The corporate balance sheet has largely been deleveraged. Equity markets have held, a lot of equity has been raised. But I think we're starting to see offshoots of CapEx demand, whether it's coming up in sectors that are finally seeing capacity increases, or the capacity utilizations are picking up as some of the government schemes like PLI schemes gain momentum for the Make in India movement. And then I think the final point here on the macro is the demand for credit from emerging corporates, the new age entities, is also picking up. I mean, it's a meaningful setup now in India where almost 100 companies have sort of become unicorn. And these are now employing huge amount of people, disrupting a lot of different industries. And equity is flowing in, barring the funding winter that we've seen the last 6 months. But over the last 2-3 years, there's been a lot of equity that this sector has raised. And on the regulatory side, once again, given the IBCNA and a lot of the precedents around solving of bad assets, now I think as a lender, pre-17, I think you had to rely on the borrower or the promoter to pay up. Otherwise, the regulatory framework wasn't conducive. But I think the discipline that now with the financial covenants and the threat of going into bankruptcy is forcing borrowers to lever up wisely rather than lever up maximum, and also adhere to financial covenants or payment restrictions much more versus what it was. I think just take you through the overall, how do the debt AIFs stack up as a comparison, as an alternative to other fixed income investments that's available. I mean, from sovereign bonds or the GSECs, anywhere between 7 to 8%, depending on what tenors. And I'm talking about not the tenure, but more shorter end to kind of compare with where the AIFs are. Bank FDs anywhere between 4.5 to 6.5%. One emergence that we've seen is in single name corporate NCDs and MLDs. A lot of investors have kind of expressed interest into going into single name NCDs or MLDs, given the tax efficiency. They are in the range of anywhere between 7 to 9.5%. And then the corporate funds or the credit risk funds, which focus largely on the AAA or the AA segment, maybe about a 1% lower or 100 basis points lower return because of the diversification benefit, but there's a fee that these guys charge. And when we compare it to where the debt AIFs in the country are committing to sort of generate returns, it's in the 13 to 18%. So we think it's almost a no-brainer for investors to look at this, given the diversification, given the active portfolio management, and given the tenor of these are largely matching some of the other investments that are available for mutual fund for investors. Just a comparison once again in terms of where these closed-ended debt AIFs are better or worse, or how do they compare to the two sort of comparables. One is the open-ended mutual funds, and the second is the traded single name NCDs or MLDs. It's a diversified name similar to the mutual funds compared to a traded bond or an MLD, which offers a more idiosyncratic or a specific concentrated risk on a single name. Most of the funds carry some sort of both credit risk as well as interest rate risk, whereas closed-ended debt AIFs, given their matching inflows and outflows, only carry credit risk. So as long as we are holding a bond to maturity and repaying the investors at the end of the tenor that we've committed, the closed-ended AIFs only carry credit risk. The taxation is different. The taxation is marginal tax for credit or debt-ended closed-ended AIFs, compared to capital gains for open-ended mutual funds. And traded bonds and MLDs have marginal tax or capital gains depending on what's the tenor of holding and whether it's an MLD or an NCD. Liquidity, obviously, for debt AIFs is low, given some of these are closed-ended and you have to hold it to maturity. That's one thing where debt AIFs lose out compared to the open-ended mutual funds and traded bonds and MLDs. And finally, the product orientation, open-ended mutual funds, a lot of investors are retail in nature. Traded bonds and MLDs largely are HNIs and family offices. But besides HNI and family offices, a lot of institutions like insurance companies and pension funds, are committing more and more to the close-ended debt AIFs, given their ability to cherry pick the right strategy and the right manager. It's also a sector that is getting a fair bit of liquidity, and also the returns that the funds have generated. These are all from CRISIL reports, so all audited numbers. If you look at since FY17, these funds have generated anywhere between 10 to 15% return on a net basis. Some years have been better, or some years have been worse. But now we have enough a track of a lot of capital that's gone in, and the investors can see the range where these returns have been, and generally they've all very well outperformed the vanilla debt mutual funds. And the capital that this segment is attracting is increasing. It's now 2.23 lakh crore across all category 2 funds compared to 84,000 about 3 years back. So there's almost market has tripled in the last 3 years, and we expect this growth trajectory to continue. Now, in terms of what does this mean for what are debt AIFs doing to capitalize on this opportunity, which is on one side totally constrained with the participants like banks, NBFCs, and mutual funds exiting, and on the other hand, a demand for credit coming back both from emerging ecosystem as well as established corporates as capex cycle picks up, is basically saying this is a alternative to a traditional debt, where you offer a higher return, but you offer a lot more flexibility compared to traditional debt. And when this is compared to traditional equity, like a private equity, this offers a lower return, or investors get a lower return, but a lot more stability as far as repayment or the tenor of their instrument is concerned, right? So this slide just talks about, I think, the growth needs or capital structure or event, which are classic cases for why private debt is needed. I want to put your attention to the table below, which is private equity, a lot of upside sharing. Traditional debt is generally a fixed return, low return instrument. Private credit tends to be more expensive than traditional debt, but less returns that investors will expect to generate compared to private equity. But the key difference versus private equity here, 100% of the principal is protected. Most of these private credit instruments are well structured with security, with scheduled repayments, compared to private equity, where you're taking the risk on when the company gets listed or are unable to sell my stake in the market. Similarly, monitoring rights are less compared to private equity, but significantly more compared to a traditional debt. Most of the private debt come with very, very onerous covenants to ensure that the debt stack is protected. Very frequent MIS reporting and covenants on that, as well as management interventions and discussions with management frequently. Return profile is medium to high, so it's somewhere sitting in between a private equity and a traditional debt. And the diligence requirement for private credit is very similar to what investors will do on the private equity side. And the timeline to commit is also something which is comparable more to private equity than to the traditional debt. When we look at the country in terms of what these private debt or the CAT2 debt instruments are offering, I think we can break it up into 5 different subcategories, right? There's the traditional credit to other financial institutions, lending to other NBFCs and MFIs. These yield anywhere between 11 to 14%. These are also shorter tenor products, between 2 to 4 years of maturity on the underlying investment, and debt AIFs and similarly will have a matching or maybe slightly longer. Emerging corporate credit, which again consists of either venture debt or just vanilla debt. Some of these come with warrants attached to it, so investors can participate in the upside of some of these companies. They yield anywhere between 13 to 18% return. The established corporate credit, which then deals with more traditional manufacturing businesses, and some of the sectors that are good consumers of emerging corporate credit are auto ancillary, chemical, pharmaceutical, sort of a lot of where there are mid-sized companies in that space, which consume corporate credit through the private market. Real estate is another asset class which is very, very different to all of these. Yields are much higher, but given some of the challenges in the economy in the last 3-4 years, we've not seen a lot of new fundraisers that have come up in the space. And finally, the entire special sits and distressed credit, which focus on almost equity kind of returns, because these are event-driven risks, concentrated risks, which more institutional investors understand, given the return profiles are a lot riskier, but much, much higher. So the entire debt AIFs are innovating across one of these five strategies, and whether it's a low risk, low return 11% number or a very high risk, high return 18+% number, all of these categories appeal to different investors depending on what the risk and the return requirements for each investors are. And finally, in terms of what are in terms of closing remarks, I think the market is set to explode on account of innovation, benefits that this provides to investors compared to traditional debt, and where I think we've seen a lot of debt AIs come up is in slightly moderate risk, but also beating the mutual fund returns. We think the space will expand because a lot of investors are coming up with different requirements for what whether it's asset liabilities provide, where their diversification needs are, what tenor are they willing to commit capital for, what segment are they interested in backing. So this segment itself will increase in terms of more better sort of coverage of the risk return curves. In terms of what does the industry need from whether it's regulators or investors for its next leg of growth, I think number one point is taxation parity. So while mutual fund investors, one of the disadvantages of debt AIFs is that as a mutual fund, you get benefits of a lower taxation compared to an AIF, which is a pass-through taxation on the category 2. And second is some sort of a liquidity, whether it's on account of listing of fund units or a secondary market, where while you commit for 4 years or 5 years or 6 years, depending on how long or what's the tenor of the fund, but in case investors need certain liquidity at their disposal for some of these close-ended debt funds, there's a market that allows them to get liquidity. It could be at a discount, it could be what the buyer is willing to pay, but at least you have a choice which right now doesn't exist. So I think these are the two asks, if I may, for what the category 2 debt AIFs have from regulators to kind of make it more attractive, given a big need that it's serving in the economy of disseminating credit in segments where banks, NBFCs, and mutual funds are currently absent. So I think this is this kind of Aditya concludes my session or what I wanted to cover. If there are quick 1 or 2 questions which you have, I'm willing to take it. Otherwise, maybe we just wind up the session and let the next speaker come on.
Sure, sir. Thank you so much for this quick recap. Audience, if you have any questions, we have a few minutes to go for the next session. So please use that ask a question button and post. I'll be happy to take them. So, okay, I've received a general question, Saurabh, but nevertheless putting it up to you. What is your idea on reducing ticket size of PMS and AIF for wider participation?
Yeah, I think it's an interesting point that you raised, Aditya. In fact, just some time back, the PMS ticket size was raised from 25 lakhs to 50 lakhs, and AIF continues to be at 1 crore. So on one hand, I think it's a balance really, because if you reduce the ticket size, it offers a lot more investors access to some of these products. So it's good for the industry overall. But I think regulators are also concerned about mis-selling or selling of some of these or funds which have lack of liquidity to investors if they are committing more than what they can. So my sense is we will not see a change in this number of 1 crore. Given what has happened on the PMS, which is the ticket size has gone up from 25 lakhs to 50 lakhs. My sense is this will be a 1 crore minimum ticket size, at least in the near future. I don't see a change on this, given what the regulator's mindset is more investor protection and sort of ensuring they're not missold rather than enabling or expanding this market. I think that's probably a second priority. First priority is still on the investor protection.
Sure. Okay, while you did mention some of the disadvantages, but there's another question. So if you want to just expand your answer, what are the disadvantages of credit AIF? Or I may just add, what are the advantages and disadvantages of credit AIF vis-a-vis other products? You did speak about that, but if you would like to expand.
Yeah, so I think this just compares credit AIFs to open-ended mutual funds, which are debt mutual funds and single name bonds and MLDs. But if I compare credit AIFs to equity AIFs or equity mutual funds, I think it's all about diversification, because I think we've seen India largely is an equity-driven market, right? People understand equity, they want to make tripling their returns, and it's a very, very equity-oriented mindset. And when people think of debt, they think about bank fixed deposit or mutual funds where you get 4, 5, 6% return, and you're not trying to make something out of it. But if you look at globally, and it's a very interesting trend, most HNIs and family offices have significant allocation to debt as an investment rather than equity. And equity is played again through largely the mutual funds or the retail investors. So given one, the predictability of returns, second, through the cycle, what the manager can generate, equity will see up years and down years. Last 6 months, 8 months have been difficult. The 2 years before that were good. COVID sell down was obviously extremely painful for most equity investors. So really, we are positioning debt AIS as a diversification play, and most investors tend to be underpenetrated in credit, and debt for them is largely bank fixed deposits or liquid mutual funds, which offer very low return for that asset class.
Sure. One more question. So, how do you gauge the geopolitical risk that we're facing right now all around? And
yeah, so
what's your prognosis on the short to medium term impact on the debt funds?
Yeah, so I think most debt funds tend to stay away from anything that's event driven, especially in the performing credit, right? Given we are not trying to make a 5x return, our job is to steer away and not get into anything which has even a remote chance of not going well. And what we've seen is supply chains have been disrupted, given the Russia-Ukraine war. We've seen, because of the tension and the geopolitical tension with China, a lot of imports have stopped, a lot of exports have stopped, which is creating an issue with respect to electric vehicle as an example, where on one hand the government is truly encouraging Make in India and getting out of fossil fuels. But if your entire cell manufacturing happens in China and you have to rely on them for all your batteries, which then power the vehicles, you're kind of caught into, I want to do this, but I know I have to rely on China. And eventually you want to be, kind of not relying on them, but that's going to take 5 years, right? So as debt investors, we tend to steer away from all of this geopolitical risk. I think the new age economies are generally less exposed to this segment, given they are very, very services driven, or within products also less exposed to global supply chain. It's a very, very, I think the smaller the company, the more self-reliant you can be, at least in the segments that we've seen. But yeah, I think there's been the impact, and I think most companies the larger companies have found a way to go about it and sort of mitigate the supply chain risk, but it's a risk nevertheless.
Sure. Audience, we are almost done with the time. If you have any questions, please quickly put it up. I will just wait for another half a minute. So till we get a question, Saurabh, I mean, just a question from my end. From a distributor, a wealth advisor point of view, especially an independent financial advisor who wants to market products, your products, credit products, are they, I mean, you've spoken about advantages of AIF, credit AIFs and all that, but from a distributor point of view, are there any specific things that these people should keep in mind, or their advantages that they may have in talking more about credit products to their clients?
Yeah, I think it's it's a very, very curated portfolio, right? So someone who's investing into these debt AIFs and any strategy they pick up needs to understand what the manager is trying to do, what is the manager's competence into executing that strategy, and eventually what is the risk, what's the return, and what's the cost associated with that, right? And they can pitch this to the investors generally where diversification need is high. In some cases, some of the clients also have an income need, right? Because most of the debt funds tend to be cash flowing, where on a quarterly basis, the units get a distribution, and that sort of helps them at least match or beat a traditional fixed income instrument. So it's an alternative to that, and anything that you get at the end of the tenor is then sort of, you can call it as an upside of a debt AIF. And finally, I think the other thing this lets investors do is to keep track of what is happening in a particular segment. I mean, I mentioned these 5, but let's say if you want to know what is going on in real estate segment, I think the fund that they've invested in is not just providing them returns, but also very useful inputs in terms of what is happening to that ecosystem, right? Emerging corporate segment that we really like a lot. There are so many different companies, a lot of companies that are coming up to disrupt an existing industry. Investors can get to know more about these, whether they are from that field, whether they conduct a business that's competing or similar. I think people get to know and learn about some very interesting opportunities and products if they're investors into a fund like this. So I think it's not just a diversification risk reward equation. It's also an understanding of how that segment is behaving, what the equation is, and how they will get impacted in case that segment gets disrupted even more. So it's really a learning for most investors.
Sure. So one just follow-up question that came up on the same lines is, in your experience of dealing with private investors, family offices, and high net worth investors, what is a typical allocation to such funds that you have seen in a portfolio?
So, alternative allocation is increasing. So most investors that we meet are anywhere between 15 to 25% allocated within alternatives as an asset class, besides the regular mutual funds or bank FDs or other instruments. And I'm talking about non-real estate here because that's a very difficult equation to bring in. If you live in the house that you own, or is it meant for some commercial purpose? So I think that's difficult. But if I just look at non-real estate financial investment, alternatives tends to be between 15 to 25%. Debt right now is almost half of that right now, and the other half tends to be private equity, venture equity. So if I have to hazard a guess, maybe 10% of all portfolios will probably consist of debt AIFs, and I'm talking about a mid-sized investor, not a very small investor.
Right, of course. So that's great. So super, Saurabh, thank you so much for this very, very informative session. Look forward to slightly more detailed ones with you. For now, we'll have to jump on to the next one. Thank you. Have a great day.
Thanks.
So audience, we have our next speaker here already, and we'll quickly dive into our first showcase session of the day. Ankur, are you here?
Aditya, I'm here. Just give me 1 minute.
Yeah. You are the co-host now.
Yeah. Okay, let me just give me 1 minute. Aditya, is my screen visible?
Yeah, it is visible. So, yeah, so before you start, audience, on your behalf, let me welcome Ankur Jain, Managing Director, InCred Alternative Investments, for our first showcase session of the day. Ankur, welcome. And congratulations. I believe this is like a very, very fresh fund, just recently approved by SEBI, and you guys have just started working on it. So I'm sure this will see new heights. We wish you all the best for this.
Yep.
And we're very excited to hear more about the InCred Credit Opportunities Fund Part 1. So before you start, let me take this honor of quickly introducing you. So Ankur he joined InCred Alternatives with over 15 years of alternative investing experience in India, out of which 6 years he has done private equity investing and the balance across operational consulting and private credit. He was earlier associated with KKR, Edelweiss, Alvarez and Marshall, WL Ross and Company, and DB Zwirin and Company. I hope I'm pronouncing them right. His experience straddles vertically across public and private markets and horizontally across investing, portfolio management, and exits. He's among the only few investing professionals in India who has worked across market cycles and experienced investing, exits, and workouts. Ankur holds CFA and MS Finance degree from ICFA University. So welcome, Ankur. And as you're aware of the format by now, we have around 18 to 20 minutes. We are running a bit late now. So we have around 22 minutes for this session. So please take your time. We have some time towards the end, we'll be happy to facilitate the Q&A for you. So over to you.
Thank you. Aditya, thank you for kind words. Thank you for introducing me. And good evening, audience. You made my life easy actually of presenting this product because before me we had Saurabh. So he took actually most of he actually introduced to the audience most of the macro environment around fixed income and what we are seeing a shift from open-ended fixed income investment products into closed-ended. So in that sense, that message is already conveyed. So most of it Saurabh has already done. So my job is in that sense relatively easier. I just have to introduce the product. But thank you. So audience, as a house, there are three things which underpins the product which I'm going to introduce today. The ICOF one, the way we call it as, or a closed-ended debt AIF. Factor number one, we think the macro of investing into fixed income is improving significantly. Probably is the best vintage to invest into fixed income investments into the country right now. From a pure risk reward perspective, fixed income investing for investors in India has never been better before. So that's factor number one. Factor number two is our endeavor to bring, I would say, a portfolio management style of investing. So basically focus around portfolio construction, portfolio granularity, towards being able to earn on behalf of our investors the kind of returns on the risk-adjusted basis that we are asking the mandate for. And the factor number three is around our own capability as an institution, the track record, if you will, and our own track record as individual team members. So these are the three things which underpins the way we have designed the product, which I'm going to present now. So here I start. The first factor which I said, if you recall, is our view around macro, around macro environment, how we think fixed income or credit investing in the country is panning out. Most of the slides, as I said at the top, Saurabh has already covered. So some of these is going to be repetition, but I think it's good to recall those because it just sets the background around which this product has been designed. So if you see, and we specifically thought about identifying these two subsegments or credit providers in the country. They are banks and they are NBFCs. The banks and the NBFCs, I would say, constitutes most of the incremental credit dispensation to this country. And look at what is happening on the market, on the bank side. As the time is progressing, banks are either shifting towards their incremental credit for the top rated borrowers of the country, or they're focused only on the retail. This missing middle is what is suffering from non-availability of credit from banking segment. Dovetail that into some of the flexible credit strategy or flexible credit needs. I would say some of the private and new age banks in the past for providing credit in that subsegment also. But even those banks have stopped lending to that segment. So the entire missing middle and let's say some of the flexible credit needs is not provided by banks, which is causing a big supply white space for this kind of credit. The demand still exists, but the supply is not there from the banking system. Similarly, if you shift your attention towards NBFC, you would see the same story. Either the wholesale NBFCs have stopped existence quite literally, or are non-existent quite literally, or you would say again they are mimicking or mirroring what large banks are doing, which is basically focusing on retail. So the two largest credit providers in this country, I would say from a private credit standpoint, as well as people or the companies which are requiring vanilla credit requirements are not able to get that, either because their vintage is lower, they're just 3, 4, 5 years in existence of their life, or their need are in that sense not strictly the need what a bank would put that as an end use, approved end use. Two small credit providers, I would say, outside of banks and NBFCs, which is the mutual funds and the bond market. The story there is secular actually. I mean, those were fringe players anyways, and with the dislocation which the Indian credit market saw in post 2018, so post 2019, has actually decimated even that small category. So in summary, what we are seeing from the traditional credit providers in the country, as well as the fringe players, no one is really catering to the demand which we would call as let's say a flexible capital requirement, which actually makes us actually wonder why, which makes us wonder how this demand will be catered, and actually in the same vein excited about credit investing into this country. Another macro point which I want to cover is around this emerging corporates ecosystem. This emerging corporate ecosystem is now has reached to a level which cannot be ignored. Look at the number of unicorns that the country is making, 44 in 2021. By the way, this was a year when India for the first time overtook China. China actually created 42 unicorns, but India created 44. So more than China. Impressive. Look at the number of people who are now employed into this emerging corporate ecosystem or a startup world. More than 4 million people. This is probably more than the entire pharma sector put together, which has been in existence for the last 15, 20, 25 years. And India probably is one of the leader in pharma segment. Look at the amount of investments which is flowing into this segment and is growing this segment. The amount of capital churning, or let's say the exits in this segment, all of them is pointing towards the fact that this is a segment which just cannot be ignored. And by the way, this is a segment where none of the capital providers, be banks, NBFCs, mutual funds, capital markets, serve from the demand, from the supply perspective. So through these 3 slides, I just wanted to convey a message that on a macro basis, purely on the demand and supply side, and a lot of has been written. So I will not bore the audience with more details, but purely from a demand supply dynamics perspective, there is a huge, I would say, a supply white space which has to be somehow filled. And this is where our product has been designed. So what are we talking about when we are saying this is the first fixed income product that we're launching? This is nothing but, as I said at the top of the thing, we are bringing portfolio management style towards fixed income asset management, which is underpinned again on portfolio concentration, construction and portfolio concentration. We are basically bringing uncorrelated risks and creating a curated portfolio for the investors. Our target is basically to create a portfolio which is a multi-strategy portfolio of 3 subsegments. 40% emerging corporates. If you recall, this is which is the previous slide which I showed. 40% established corporates, and 20% towards financial institutions and platform. Mind you, these are the sectors, again, if you recall, purely from the supply perspective, the traditional people have vacated or never catered to. So we are creating a portfolio which is a combination of these three sub strategies in a defined 40-40-20 proportion, which we are also trying to create, let's say, a granularity into the portfolio, where we are saying that a single investment is not going to be more than 5% of the overall portfolio, which means we are going to do 20 plus transactions into this portfolio. So portfolio construction, we are very thoughtful about, and portfolio concentration, we are very thoughtful about. It's going to be a 500 crores plus 500 crore green shoe option fund. So in total, 1,000 crore fund. With a target yield of 17% gross IRR. We have kept this fund as a short fund because we do not want to take a huge interest rate risk. We see our view on the market is right now. We think right now is a market where this demand supply attractiveness exists, as a result of which these kind of yields are achievable. We do not have the same view 2 years out. Who knows, the demand supply dynamics will remain the same or will not remain the same. However, we think the opportunity is right now. Hence, we have kept this portfolio as a very short portfolio, 4 years from final close. So, and from the 17% IRR that we are targeting of the overall portfolio, we think we are targeting at the minimum 8% out of the 17% to be in the form of regular cash distributions. In addition to us individual as investment team, as well as the Incred ecosystem, we are also very thoughtful around how we are going to approach governance of this entire fund. Will it have a mix of internal people, external people? How we are going to do? How are we going to use some of the wisdom of external committee members? I'll come to that shortly in the subsequent slide. So, as I said, we are very thoughtful about portfolio construction, the 40-40-20 construction rules that we have put. So we have tried to put that in form of a slide where we talk about what is exactly the zone that we are going to actually play into, and this is what it is. The way we see corporate India landscape, we see corporate India either as early stage corporates who just started, probably between 0 to 3 years of their existence, largely being catered by venture equity, venture capital guys, and to a certain extent, even venture debt for their capital needs. These kind of corporates are, from a unit economics, EBITDA and free cash flow basis, negative. Hence, the risk is more oriented towards equity because the risk that they're underwriting is more existential. As we move along into the life journey of a corporate, the venture or early stage corporates transfers or translates themselves into an emerging corporate. This is a category which we think is 4 years plus in terms of their age. They have established their unit economics. We know the existential risk doesn't exist or relatively reduced to a large extent for an investor like us to be comfortable. They might not be EBITDA positive or free cash flow positive just yet because they chose to reinvest most of the gross profit generation again back into the company and actually building that cost base right now, which is for the future, maybe not for the present, but for the future. As a result, they're EBITDA negative and free cash flow negative. This is a time when some of these guys, in addition to venture debt, can also be catered through private credit as a platform. And from emerging corporates, the companies then metamorphoses into established corporates. These are the companies where the unit economics have become positive, even the EBITDA has become positive, and sometimes even free cash flow positive. So this is the play zone for the fund that we are targeting, and the 40-40-20 is going to be effectively into this. So mind you, we are not going to actually invest into companies who are not even established from their unit economics perspective. No one knows how this business model is going to really pan out and whether these companies will remain in existence after 1 year. So these companies have already established their mark. If they're into, let's say, consumer segments, then market shares has been established into their key geographies. If they're into, let's say, some of the branded play, we know that they are well and truly there in terms of challenging and established brands. So the risk of I'm making this point again, the risk of existence for this company no longer exists. This is another point which I want to highlight, and this again underpins the way we defined our strategy. No more this portfolio is going to be curated and is going to be managed by, let's say, just us individual as investment team. It is going to be curated purely both from deal doing basis as well as on an ongoing portfolio management basis between the investment team, the InCred ecosystem, as well as some of the external advisors that we have to the fund. We have stringed along basically 3 market veterans who we think their wisdom will actually help us in terms of curating this portfolio as well as managing this portfolio so that we can deliver the 17% IRR to our investors. We have stringed these 3 individuals into credit committee, which is a gatekeeper in terms of doing new deals, and portfolio management committee, which is a gatekeeper in terms of regular updation, monitoring, any covenant tightening needs to happen or any exit event needs to be done. Who are these 3 individuals who have graciously agreed to be external advisors to the fund? Mr. P.N. Prasad, Deputy Managing Director of State Bank of India. Mr. Debashish Datta Gupta, ex-Citibank and Lehman Brothers, and Krishna Datta, who is a lawyer by background. So a credit guy, Debashish brings risk management and external market skills to the table, and Krishnava, who brings legal skills to the table. All these 3 things are required for any kind of fixed income investment decision making as well as fixed income asset management. You need to know who you are lending to. You need to know how some corporate houses, borrowers, as well as some of the industries have behaved in previous cycles. You need to know if something needs to be done proactively, how should your lending documents be structured? If something needs to be done on a reactive basis, what should your enforcement strategy be? Hence a lawyer in the mix. So the point that I'm making is it's one of the most important, and we treat this as one of the most important feature of our fund, where we are stringing along the right kind of external talent who acts as an external and independent gatekeeper in terms of creating this portfolio for the investors, helping us create this portfolio for the investors, and our ongoing monitoring of this portfolio. The third thing which I said, which underpins the strategy for us, is our own track record, be it individuals or the platform. So InCred as a InCred as a platform has actually, since last 5.5 years of its existence, has on a cumulative basis lent close to 2,200 crores of credit to such kind of, let's say, corporates. These are approximately 150 unique borrowers. And I mean, we are actually very proud when we say this. In those last 5.5 years of our lending or play into this market, we just have, let's say, 1 accident, and that too very small. And again, if we really dissect why it happened, it's not that we made a brilliant decision, etc. It just our diligence and diligent approach towards investing, and also our granularity. We have kept very high standards for us in terms of doing per deal ticket sizes, because we think at the end of the day, what is the difference between a private equity and a private debt? The range of outcomes in private equity can be that much, right? The variability can be that much. You can have 30-40% IRR, and the way down it can be 0, right? If you see private debt, the range of outcome is narrow. You just have to play in this zone. You're making 17% or maybe 16 or maybe 15.5. You're not going to make more than 17% return, right? So hence, you should have every single decision right. Every single investment that you're doing has to hit the mark in terms of your underwriting, and all that can happen only at the portfolio level. You have to be diversified in your approach towards investing. You have to cater to various things, many things, multiple, let's say, type of businesses, vintage of the businesses, and also it has to be granular. No single deal should result into a disproportionate change into your overall economics. So that's what we have done, what we have learned, and we are going to follow that into our into the fund that we are introducing here. Some of the names that we have lent to from in our past are given here. Most of these are public names, visible names, market leading companies of their specific segments, again, making a point that I would say most of these companies, or in fact, all these companies, existential risk is no longer there. I mean, it's not as if that these companies are going to simply just vanish tomorrow. If you just extrapolate individual team like myself as well as the other team members investing experience into India and just put that into some sort of, let's say, analytics, you would see we as a team have actually invested or lent into all the sectors, be it pharma, healthcare, autocoms, logistics, consumer, hospitality. So I would say a diversified and multi-sectoral experience. How have we really underwritten exits? The most important thing into, let's say, fixed income investing into this country, or let's say anywhere, fixed income investing generally, is what is the end state that you're projecting? Your end state is not as if the company is X, it is going to become 50X, and hence I'm going to make equity return. Your end state analysis is the company is X, it should at least remain X for it to be able to give me my coupon, my 7. Mind you, I'm just making 17% return. I'm not making 25, 30, 40 return, 40% return. So my end state assessment and monitor that path or that journey towards end state assessment has to be very, very, very strong. If you see, most of our investments have been operating cash flow driven underwritten exits. So our thesis was always been company is going to generate EBITDA, they're going to repay our debt, and we're going to go home. Quarter of our investments has been equity driven or equity event driven. From a tenor perspective, again, we think our assessment is fixed income investments on such kind of, let's say, investment strategy has to be a shorter duration. You can't take long duration risk. And that shows actually into our individual track records also, that less than 3 years, 39%, between 4 to 5 years, 59%. More than 5 years is just barely 2%. And LTV profile, again, we are very, very conservative around what kind of deals that we do, what kind of collateral that we take, and loan to value has been how much. So 30 to 50% LTV, 78% of the deals basically falls under that. How do we make these investments? So the style of investing, I would say, it's a cliche to use, but the style of investing is actually private equity style. Yeah, it's a pretty intimate investing style where you spend a lot of time with the company, with the founders, with the management team, just to understand what are they doing, what is their business model, how are they executing it, what is their future plan, are the manufacturing facilities really up to the standard where they can actually achieve what they have in their head, or what their plans are, which would involve a deep credit underwriting, both from the information supplied by the company as well as then diligencing on them using third-party resources, which we pull in along with the investment teams, let's say, understanding of the segment or the business. Post-credit underwriting, we also do something called a deal structuring, where now we know, okay, this is the way businesses' cash flows are expected to pan out. This is our thesis. How should we structure it? Should this be, let's say, 100% cash coupon deal? Should it have regular amortizations? Do company need some, let's say, lumpy cash flows because they would be investing into their facilities for capexes, for capacity and expansion? So all of that deal structuring are basically forms part of this entire activity called deal structuring. In the process, we will also put some covenants around, okay, if we have to lend this much amount to this company, then these are the covenants that the company needs to adhere to. For example, company should not, or covenants, or very simply put, the guardrails the company should operate their business into. Their working capital should not expand further post this point. Let's say their leverage should remain this. So covenants will basically puts an agreement between us and the borrower that for the next 3 years, 5 years of our existence into their capital structure, this is the way business needs to behave. And once we have given the money or money out of the door, then it needs to be monitored and managed depending on the cadence that we have agreed with the borrower, either on a monthly or a quarterly basis. It can be a light touch monitoring mechanism where it's just simply company providing their pre-agreed MIS to us. We see this. If we have, let's say, any questions, we ask, and that's end of the story from that quarter monitoring perspective. Or it can be it can be slightly more than that, where we actually have some of our own people, third-party individuals, actually monitoring the funds flow, cash flows, etc., on a regular basis. Some of the things that we like, we do not like. I will start with what we don't like. This is a performing credit fund. So the strategy that we are proposing here is performing credit. Hence, by definition, we do not do distress. We do not do stress. We have expanded the scope not to include, let's say, stress or distress into other group companies, because we think if the group is in stress, or the promoter or the founder at some other level is in stress, the stress tend to seep into even the good operating companies also. Hence, we do not, we basically, it's a big negative for us. Hence, liver distress, stress situations we do not like of the corporate that has come to us for borrowing or at the group level. Some of the sectors that we do not like also includes power sector, gems and jewelry, mining, trading sectors which has high government intervention. It could be government intervention could be purely on as a customer level, or it could be as a raw material provider level. We think entities who you not have an ability to control, it's difficult to get into those businesses where those entities exercise a lot of, let's say, control. If you recall, we do not do venture, I would say, companies which are early stage 0 to 3, where even unit economics are not established. We do not want to take those risks where company buys raw material, sell its products, and in the middle not even make money. They can be not making money because their fixed cost is high, because they chose to grow more. But if your unit economics is negative, it is something which we tend to avoid. So same point again, groups which has history of default, currently everything is okay, but 3 years, 5 years, 7 years past, there was a history of default. We again think that things tend to repeat. We do not want to take those risks. And finally, something where we are very specific about our structures, about our documents, and the collaterals that we are going to take. Hence, any kind of loan where there is a limited access to that, no, it's a big no for us. What we like is a complete ulta of what we don't like. Corporate governance and presence of institutional investors has to be there into the companies that we're lending to. Companies which are high growth sectors, companies which have positive unit economics, and basically the structure and the collateral has to be robust. Coming to the end part of our presentation. So this is in a nutshell what this product is really. Think about it. It's a performing fund, 500 crores plus 500 crore in form of a green shoe. InCred as a sponsor believes in this strategy, has a lot of view on this strategy, and hence we are putting a significant amount of money as a sponsor commitment. So 50 crores out of the 500 crores we're putting in. Yeah, and this is a fund structure that we have. So basically we have some of the advisors or marquee investors or marquee advisors as being part of this fund structuring. We wanted to do it. This is the first time we're doing it. We are serious about it. We wanted to do it right, and hence Trilegal is our legal advisor, ENY is our tax advisor. We also have, in addition to an ability to attract domestic investors, we also have offshore investors, basically through a feeder fund structure, who is going to be basically potentially investing in this fund. So this is where I end. Happy to take any questions if I have not already overrun the time allocated to me.
Yeah, you are, Ankur. I think we'll have to set up another session for you to take the Q&A because we've almost barged into next session by 5 minutes. So I think we'll have to skip Q&A for now. We can always, we would love to have a separate standalone session. I'm sure more audience can come in and everyone can benefit from this, some of these insights you were sharing. So I believe our next speaker is already here. So Ankur, thank you so much for joining in, and I wish you and InCred team the very best for this new fund. And distributors, I'm sure everyone is going to benefit from the insights that you shared. So audience, Ankur has already shared his details with you. I mean, anyone who wants to reach out to InCred AMC team, please feel free. And we'll try to facilitate a couple of more sessions with them for soon. Thank you, Ankur. Have a good day.
Thank you.
Yeah, so audience, we have our next speaker here already, and we already are running late, so I'll not take too much time to get started. Ravi, welcome. Thank you for joining in.
Thanks, Aditya. Hope I'm audible.
Yes, you are. Do you have any presentation?
Yes. Let me just share it. Yeah. Can you see it?
Yes, I can see it. So audience, our next session, the next showcase session is on Emerging Corporate Bond Fund by Northern Arc Investment Managers. And we have with us Ravi Ukadla, who's the CEO of Northern Arc Investments. Ravi has been with Northern Arc for around 6 years now, and overall carries around 20 years of experience in financial services and investments. And both he and Northern Arc have carved out a very interesting niche for themselves in this AI space over the last few years. So Ravi, thank you for joining in. And we've got another 20 odd minutes for your session.
Okay.
So the format you're already aware, but I'm just repeating so that it's more of a showcase session on the product that you run. If you'd like to put up some context around the industry and the market trends, please feel free. I am afraid I will not have much time for a Q&A towards the end, but if we do get some time, I'll try to squeeze in a few questions from the audience. Yeah,
Sure.
so over to you.
The lesser time I take, maybe you'll have time for Q&A. Great. Thanks, Aditya, and thanks to everybody for logging in. I'm sure that you're already well enriched by some of the earlier sessions on fixed income investing. So I probably won't take that much time. Thought that we'll split it across a few sections. I'm not sure on how well Northern Arc is known, given that it's a private unlisted company. So it's a public unlisted company. And I thought that at least the first section, I would talk a little bit about Northern Arc. So it's important to know an investment manager first, and then think about whether it's worth investing in any product that they would be launching. Right? Alongside that, some of the learnings from fixed income investing, while equity is glamorous and equity is something that everybody knows, fixed income is a little more confusing. And hence, just a couple of slides on fixed income investing. Then we'll talk about the proposition that Aditya mentioned. There are multiple products that we run, and I'll just give a flavor of those. Don't want to get into a lot of details where you would be doing due diligence on that. And if you have some time, then probably we'll get through credit underwriting examples, or we'll keep that for Q&A. Right. So overall, Northern Arc, as Aditya mentioned, is quite an old vintage company in the lending space. We've been around since 2008, and we financed or enabled finance of more than 1 lakh crores. We specialize in a few specific areas, largely with respect to retail credit and across the mid-market segment. Right? And in terms of our group structure, it has an NBFC, and then it also has a alternate investments platform, right? As well as PMS now. So there's a fund platform and there is a lending platform, both of which together manage somewhere around 11,000 crores as on date. And because we also help raise financing for a lot of companies, that number is more than 1 lakh crores. So given that we've had quite a long presence in this segment, we've collected a few awards along the way, most notably on the investment management aspect. Right? So we've been focused as probably the only Indian asset manager on the most consistent private debt fund managers by Preqin, which is a global platform. Impact Assets 50, which comprises of or which does a yearly tabulation of the 50 most impactful asset managers all across the world, has included us 2 years in a row. So this is a global kind of an award and a list of only 50 asset managers in which we have made it on consecutive years. And besides that, some local as well as Asian awards, largely goes testament to the kind of presence that we've built and the investor experience on how it's been investing across all of our funds. On our own structure, we are owned largely by a few private equity kind of funds, Fidelity, StanChart, India Infoline, as well as the Japanese mega bank, all hold stakes. And we have filed for and received approval for a public listing which hopefully should happen sometime shortly. In terms of governance, I think that's what matters the most. While your shareholders can be anybody, it depends on who is at the board to make sure that the company is well run. And our independent chairperson is Mr. Jaykumar, who was earlier the MD of Bank of Baroda. And before that, he was at Citibank. Besides that, in terms of notable independents, we also have Ms. Anuradha Rao, who was the ex-MD CEO of SBI Mutual Fund and stepped down a couple of years ago, and since then has been an independent director on our board. Just quickly, in terms of what we've been doing on the fund management platform. So we do only fixed income, and that's what this session is about as well. Overall, we have 9 funds so far, of which 4 have matured completely. Right? So 4 funds no longer exist. They have collected all the capital, they have invested, they have returned the capital and met and exceeded returns in each and every one. Across all the 9 funds, we are at higher than target kind of returns. So that's something we are very proud of in terms of our track record. It ranges in the 12 to 15% kind of yield segment, except in the open-ended fund, where we run a more 9 to 10% kind of investment. Right? We have largely been an institutional player, and hence, while I say that we have a long track record of more than 8 years of managing funds, and this is our 10th fund that we're launching, you wouldn't have heard of us significantly. Right? We've largely had large institutions which are investors in our funds. So DFIs such as SIDBI or a NABARD, banks, SBI, Ratnakar, and a few banks. Across insurance companies, almost every private insurance company has invested with us. So whether it's a Kotak, Birla, Reliance, India First, there are family offices such as the promoters of Infosys, Cipla, Azim Premji, you can name it. These are all the kind of investors which have invested across us, across our multiple products, and have then continue to back us. So I think the first take in terms of what is the track record for an investment manager, what is their presence, who are the others which have invested, is kind of well met by Northern Arc as being one of the oldest fixed income private credit fund managers in the country. Overall, we have raised more than 5,000 crores of commitments. Current assets under management are more than 3,000 crores, given that we have returned a lot of capital across the exited funds as well. And we have about 5 strategies which are live. So that's largely about us. How come this product hasn't been out there, or what are the challenges that we typically see in fixed income investing? But I would just have why fixed income continues to attract more capital and the challenges along with it in the next couple of slides. I think the landscape in terms of what banks are focusing on, where the opportunity is, as well as the fact that fixed income continues to be one of the largest absorbers of capital, has been well made. I think given that you're in a fixed income summit, the presentations before would have covered this aspect. One large provider of capital, which was mutual funds, has stepped away from this market. So if you step back and see, if somebody wants to raise money, right, where do they go? There are 3 large buckets of capital in India. One is the mutual fund segment, which was running credit funds and has subsequently, after a couple of incidents, if you see the top right chart, that has come down significantly. The second is the banking industry, which has been the provider of capital of choice. Almost everybody has a loan from a bank, and that continues to be the largest and the most sought after kind of provider of capital. Besides that, there is money which is locked in terms of 30-40 lakh crores in insurance companies as well as in the pension funds. But there is a big restriction in terms of the credit that these pools of capital can take, and hence their investments largely tends to be in the sovereign kind of mix. Right? So if you look at the providers of capital and how they have behaved, right? I'm clubbing banks and NBFCs together, but mutual funds have stepped away. Insurance and pension weren't really there to begin with, and after the couple of incidents such as IL&FS and DHFL and Reliance Capital, they're not inclined to participate in this segment directly in any case. It largely leaves banks and NBFCs. And so far, they've been the ones who've been meeting this need. But from 2012-13 onwards, right from the period of 2009 to 2012-13 is when the banking industry went on a binge in terms of lending to corporates. And a lot of the NPAs that are still residing on some of these balance sheets, as well as some of the proposals that are in the NCLT, as well as the insolvency kind of courts, are with respect to lending to corporates that happened in this segment. So banks have shied away. NBFCs also seen some sort of an increase in NPAs and have largely moved towards the retail lending segment. So as a retail consumer, I'm sure that you are bombarded with respect to NBFCs, fintechs, everybody offering you loans, because that is the segment that they're chasing. And hence this leaves a gap. There is a lack of financing that is available to the corporates in the country. And these are not corporates which have started like 3 months ago or 1 year ago, but these are corporates which have been chugging along. They have many needs, everything from working capital to capacity expansion. And a lot of this is not met by the current availability of capital in the country. And hence, some of it is being moved to an AIF kind of structure. Now, even when investments are happening, say, due mutual funds, what are the key risks associated with fixed income investing? I think as an investor, the mental buckets that I have is, when it comes to equity, this is the risk capital. This is where I want high amount of returns. When it comes to debt, this is where I want to make sure that this money comes back to me. Right? I think that's the clear division between how I would look at debt versus equity investing. And frankly, over the last 2-3 years, given the risks that are played out in the debt segment, a lot of investors have kind of shied away, saying that with good reason. I mean, there have been some defaults and money has been lost or has been locked up. Right? So there are 3 main risks associated with fixed income investing. Right? The first and most obvious one is the fact that you will not get your money back. Right? So if you give a loan to a friend of yours or to an acquaintance, the risk is that the money may not come back. So that's a downgrade or a default risk. And that's where the credit assessment need is the most necessary. You have to figure out on the ability of that person or that company to continue to earn or to generate cash flows so that they are able to repay the loan. So if the loan is being taken to for spending into say a car or a dead asset or something that doesn't help in produce anything, then obviously there is a risk in terms of how is the person going to repay. But if the loan is being taken to fund an education or to fund a machine which can generate profits or earnings, then obviously the money can come back. So the end use dictates on whether the potential for a person or a company to pay back is there. That's the main risk, which is credit risk. And when you think of fixed income investing, that is the only risk that somebody thinks about, saying that, am I going to get the money back? Right? Now, if it is a direct loan, then the other risks don't really come into the picture. But when the vehicle or the place where you take this risk brings into account 2 other risks, which is market risk and liquid risk. And I'm sure with a lot of the investors out there who have participated in mutual funds in the past, these 2 risks were not the ones that were originally thought of, saying that this could impact our returns, but eventually it did. Right? So if you take the example of what happened with the mutual fund, which had to close their schemes for redemptions and then subsequently paid out the capital, market risk was one of the largest challenges, which is basically a change in interest rates. Right? So every time there is the value of a company changes by way of an interest rate risk or because of a downgrade, that is an element of market risk that comes into the NAV. So your investment value fluctuates. Now, most investors are used to or would like to invest in a proposition similar to a fixed deposit. That is intuitively the debt structure that I understand, that my parents understood, and that most investors understand. That if I give 80 rupees and after 2 years I'm going to get 100, or after 3 years I'm going to get 100, that is what I understand. I am not concerned with what happens from day now to the date at which I'm going to get my money back. But when you put this investment in a mutual fund and there is a daily marking of how the investment is moving, and some investors can come in and some investors can go out, this impacts your fluctuation. Now, because of this, the actual return can vary than what you would have estimated when it's in a pool of securities. When you're holding only one security and you're saying that I've invested 80, I want to get 100, that's fine. You're not really dealing with market risk. But in a fund proposition, market risk is an inherent nature of any open-ended product. Along with market risk comes liquidity risk. And this is a feature of the Indian debt market. You call it a bug or a feature. But the fact is that when you want to sell a paper, when you want to sell a security, buyers suddenly disappear. Right? And this is what was seen across mutual funds as well, that in a good going market, you will have liquidity for the Indian 10-year GSEC. You may not have it for the Indian 4-year GSEC or residual tenor of 4 years. There are only some securities where the buyers are always available. Right? So 1 month, 2 month papers that typically liquid funds will trade in, the AAA, the A1 plus CP CDs, there are buyers available because there is a lot of money in liquid funds. But you go higher in terms of tenor, you go lower in terms of rating, and the secondary volumes almost disappears. Right? It is very opportunistic. If you put out a quote, somebody might buy in 3 days, in 5 days, in 1 month, you have no idea. Right? If a company is in distress, then there is absolutely no way that a quote will even come to buy this. Now, this poses a problem when a lot of investors want to exit. Right? So in our earlier example, where we said that you gave 80 rupees and you were going to get 100 rupees after 2 years, you're not concerned with market risk or liquidity risk. Because all you know is that at the end, on the maturity, I'm going to get that money back. And this is the beauty in a product like a FMP, right? Which is designed to eliminate both of these risks. And credit risk is the only thing that you're taking. It's also tax advantageous, but because of disclosure requirements or the fact that these products are not very transparent in terms of their portfolios at the time of construction, this is not really taken off. But that can be replicated on an AI form. Now, how do you cover for some of these risks? So a downgrade or a default risk is basically your ability to assess the repayment capacity of a borrower. And that's where the underwriting specialization comes in. Now, there are tens or hundreds of kinds of business models which are out there. You can only, or an investment manager can only specialize in a few of them. Right? Today, as I mentioned, Northern Arc has been doing largely financial credit assessment and mid-market corporate credit assessment. If you tell me anything about assessing a real estate deal, within real estate, an early stage, a late stage, a land financing deal, I have absolutely no idea on how to do that because that's not something that we've been doing. So specialization matters a lot. If you look at mutual fund structures, the kind of teams that assess multi-sector are very small. Would have hardly less than probably 2 to 5 folks who are doing investment analysis across multiple sectors in an industry. Right? So it really limits the amount of data or assessment that you can do on companies which are slightly lower in the rating scale. So specializing in the kind of investments directly links to the track record of a company, sort of an investment manager. The other mitigant of downgrade or a default risk is diversification. Right? So in the earlier example where you have given one loan, right, of 80 rupees and you're going to get back 100, if the person does not repay, you've lost the entire amount. On an absolute level, 80 rupees may not matter much. Right? Now, suppose you have 1 lakh rupees to invest. Right? And if you give the entire 1 lakh to one person, and if that person defaults, then you've really taken on a high amount of risk and you lost everything. But if you gave that 1 lakh to 100 people with 1,000 each, even if one name defaults or 2 names default and they don't give back your money, you will still get back 98,000 of principal, plus you will get the interest on the 98,000. So your total amount will still be higher than 1 lakh. Right? So despite having defaults, you have still got your principal back. And that goes back to the tenet of fixed income investing, that you want to get your principal back. So diversification is the only true mitigant to credit risk. if in a portfolio you're earning 10% returns, and if any single name is higher than 10%, that means that you will lose principal if there is more than one, or if there is one default every year. Right? If the single issuer is only 5%, right? Even if there is one default every year, if your annual earnings is 10%, then you will get your money back and you will get some returns as well. So that is what is most important in terms of how to invest in fixed income. The third one, and what we saw in credit mutual funds, is the asset liability matching. If an investment manager is promising to give money back in 3 days as soon as you place a redemption, whereas the underlying loans or investments are 1 year, 2 years, 3 years, then there is, with the lack of secondary liquidity for these names, it is impossible to give the money back, and hence the asset and liability has to match. So Instructive is the example of the mutual fund which, after closing the scheme, let all the securities mature and was able to repay everything. So the underlying credits were good. It was just the vehicle which said that I'm offering you liquidity at any time, which was not allowed it. So it's akin to this kind of image, right? There is only one door. There is only that much liquidity. And if all the investors are trying to run out, it's only chaos. So liquidity risk in fixed income is a very real thing. The Indian markets are not developed, unlike developed markets where there is a junk bond trading platform. There are enough volumes. There are a lot of participants who invest and look to resolve downgrade or low credits. In India's case, if a company faces challenges on credit, there is pretty much no exit. Right? So if everybody runs to the door, then there's only going to be one massive pileup, and we saw that happening in a mutual fund as well. So that's largely about fixed income investing. I'm conscious of the time. We only have 5-10 minutes. So I'm only going to talk about
one sec. We're actually almost out of time. So
okay.
Another couple of minutes, please, if possible.
Sure. So I just have one slide in this, sorry, 2 slides. So in terms of fund proposition, if you look at the earlier section, Northern Arc is known for its credit underwriting. And that is what we've demonstrated in terms of our track record, in terms of the vintage, and in terms of the volumes that we've done. So the credit risk aspect is taken care of. Now, the only things you have to cover for is the liquidity as well as the market risk. Right? So we have one category 3 AIF, which is tenor matched, where it is offering you selective liquidity based on the underlying. So that's a monthly investment. You can call it like a credit liquid fund, where it's an 8 to 10% kind of value proposition for investor for only holding it for 1 to 3 months. Right? Then there is the higher yield credit, where there is absolutely no liquidity, but it's a highly diversified fund, which is offering 14 to 15% gross yields, but a single issuer is only 3%. Right? So on a yearly basis, you will get 13% returns, but the single issuer is only 3 to 4%. So even if there are 3 or 4 defaults every year, you will still get back your principal. So that's how you cover for this kind of risk on top of the credit underwriting. The other vehicle is a portfolio management service platform. So given that most of the HNIs are taxed much higher than corporates, a taxation efficient structure, which earlier was available in mutual funds, is available now on the PMS side by using market linked debentures. So there is one portfolio where an investor can invest for 1 to 2 years and get a 9 to 10%, 9% pre-tax kind of return for a relatively higher yielding diversified portfolio. And obviously, Northern Arc can also do custom portfolios based on any PMS or AIF vehicle. Sorry, I just wanted to rush through this. Aditya, conscious of time, I think that's all I wanted to highlight. Happy to take any questions or take that later on as well.
Thank you so much, Ravi. Unfortunately, we'll have to skip the Q&A because we overshot this time thing. But yeah, lovely hearing. And it was like a mini masterclass from you on debt investing, and I think it was very, very informative. Would love to do more larger sessions with you, as we've always been doing for last so many years. Audience, if you have any queries for Northern Arc team, please feel free to reach out to them. And I'm sure it's a big win-win for both investors or distributors and the industry per se, with players like Northern Arc and Incred coming into this field. So thank you, Ravi. Have a great day. Look forward to engage again soon.
Sure. Thanks, Aditya. Thanks everyone
Thanks.
for tuning in.
Bye.
Bye-bye.
So audience, quickly moving on to our next session. We have with us Aditya Gore from Edelweiss. Aditya, are you there?
Sure. Bye. Thank you.
Yeah, hi. Do you have a PPT that you'd like to share? You're on mute. Hello. Can't hear you.
Audible now?
Hello.
Yeah, hi. Am I audible?
Yeah, you're audible now. Yes.
Sure.
All right. So thank you for joining in, Aditya. We'll quickly jump into the session.
Sure.
So, audience, we have with us Aditya Gore, who's the head of international sales coverage and fixed income research at Edelweiss Wealth Management. And he's going to talk about fixed income investment opportunities across the risk spectrum. So, Aditya, welcome. I believe your first time with us in any of our events. Lovely to have you here. Quickly, to inform you about the format, this is purely a showcase session for products and platforms. And we've been covering different asset classes on different days. Today is fixed income, as you're aware. We are running behind schedule, thanks to the first two sessions, but roughly we have around between 15 to 20 minutes for your session. I don't think we'll be able to take Q&A towards the end, but request, hopefully we'll have some standalone sessions soon with you. So yeah, thank you. Over to you.
Thanks. Thanks, Aditya, for giving me this opportunity to speak at your event. May I just request the host to enable screen sharing so that I can share my presentation?
Yeah, you're the co-host now.
Okay, one second. Yeah, hi. Good afternoon, everyone, and thanks Equalify team for this opportunity. So let me just spend some time today on this particular topic of fixed income markets as an investment avenue, especially in light of investors, which is a new growing class that we are seeing in the market, which typically alludes to all the wealth houses, fund managers, and other retail / HNI as well. So let me just divide the session in broadly two aspects. First, let me broadly speak about what the market, or what the fixed income market in India is. How big is the opportunity? What are the size and liquidity trends in the Indian fixed income market? And with that context, we as end investors, how should we look at fixed income as a investment avenue, breaking away from the traditional investment asset classes in the fixed income that we have seen. So, speaking about the fixed income market opportunity in India, the fixed income market in India is nearly around 178 lakh crore rupees, out of which, as one may expect, more than 50% is a combination of government borrowing and state borrowing. So the government bonds stand at around 80 lakh crore rupees, or contributing to around 45% of the total outstanding. State development loans, basically the loans issued or the bonds issued by state governments, form around 25% of the pie, with around 44 lakh crore outstanding. Treasury bills are nothing but government borrowings less than 1 year, are around 8 lakh crores, and 40% and around 25% is corporate bonds, which is around the 40 lakh crore outstanding market. Commercial papers, CP and CDs, is relatively a small portion of the overall pie in the Indian fixed income market, standing at around 4 lakh crores. So commercial papers is are nothing but bonds issued, borrowings by commercial corporates with less than 1 year maturities. So speaking about main players in the fixed income market, so traditionally what we have seen is fixed income market has largely been institutional only market, where where a large amount of the market is dominated by players like banks, insurance, pension funds, mutual funds, corporate entities, foreign institutional investors like FPIs, etc. And the retail participation in the fixed income market has been indirect, primarily through insurance, pension funds, mutual funds, banks, and even corporates to an extent, right? But one trend that we are seeing clearly, which is emerging over the last couple of years, is increasingly, the higher amount of participation that the wealth firms like us and others in the market are witnessing, in terms of participation in the fixed income market, which also hints towards, more direct retail / HNI / wealth participation in this fixed income market, which is a clear trend that we have seen in the last 3 to 4 years, that is emerging, which is breaking away from, while the proportion is really small at the moment, but yeah, I mean, breaking away from institutional players into direct retail / HNI participation in the fixed income market. So speaking about broadly, to contextualize how big is the fixed income market, if we look at the secondary trading volumes in corporate bonds and government bonds, it is quite evident that the volumes are pretty high. The GSEC market is fairly liquid, with daily volumes of around 30,000 crores. Similarly, the corporate bond market is also decently liquid, with daily volumes of around 5 to 6,000 crores. Speaking about the primary market, in terms of primary market, the main issuance is concentrated from the government of India, obviously, which stands at around 14 lakh crores for this year, which was around 12 lakh crores for the last year. So obviously, in the last couple of years, we have seen the gross borrowings double. That's a function of fiscal deficit, etc. However, just to put things in context, around 12 to 14 lakh crores is what the government or the state borrows annually. At the same time, around 6 to 8 lakh crores is the borrowing from the corporate market, corporate bond market. So we can see that, over the past 4 to 5 years, the corporate bond market, the gross borrowing has been fairly steady around 6 to 8 lakh crores over the past 4 to 5 years. So I think having this in context, we would like to draw the attention to the variety of fixed income investments that investors have in the fixed income market. Obviously, each investment in the fixed income market is not risk free. They come with a own set of risks associated with it. So one way to gauge what the risk is associated with the investment is to see what the rating is. So as we can see, a fixed income investment for a investor can vary from as low as around 4% post-tax returns to as high as around 8 to 9% post-tax returns. So obviously we have assumed a 3-year maturity in this particular slide. However, this returns will increase across maturities. So for example, 5-year would be typically higher than 3-year, and 10-year would be higher than 5-year, and so on. However, the point here we are really trying to drive is fixed income investments really offer you a variety of return profiles depending on it is investors' risk appetite, and one has to really pick and choose what investment suits one's investment profile best, and what are the return expectations from that investment, and also be aware of the risks associated with it. So if we look at a typical fixed deposit would be returning on a pre-tax basis around 6%, which is actually lower than what the government of India is actually offering at around 7%. If we keep on going down the credit curve, so corporate bonds would be typically offering around 20 to 30 basis points over and above GSEC. The AAA privates would be offering another 10 to 15 basis points over and above the AAA PSUs. Further, if we go down the credit curve into bank capital structures like AT1s, etc., the yield will be still even higher, around 765. The non-AAA space also offers decent investment opportunities with yields ranging from 8% to the single A space, which is as high as 9% or even 10% in some cases. A new investment product a relatively new investment product that is the flavor of the market currently are the MLDs, where the return profiles can also, on a tax efficient basis, range from 7.5 to 8.5, depending on the rating and the maturity. So I think just coming back to the point where we started, the fixed income market, the opportunity is really big, and one really needs to fit into his or her own return profile, that what investment suits the investor best. So definitely if we try to compare a bank FD with a MLD which is rated say AA plus, a AA plus MLD would be much more attractive than a bank FD, almost double the return. But at the same time, there are risks associated with with a bond which is a non AAA or even AA plus, right? So while one definitely should get attracted to higher returns, at the same time one should be completely aware of the risks that are involved in that, so that one doesn't end up in a situation which happened a couple of years back, right? So I think just to summarize, the point that I'm trying to drive here is fixed income investments do offer a variety of return profiles that really depends on investors' risk appetite as to where he or she sees himself fitting, how much risk which will be appropriate for his or her own portfolio. Obviously, the investment gamut ranges from as safe an instrument as a fixed deposit or a government bond, right down to capital bank structures, which are additional tier 1 bonds or even MLDs for that matter. So obviously, given a rising rate environment that we are in, higher yields can be achieved by either going long duration or going down the credit spectrum in high quality names in a shorter duration bonds. So we are of the view that in the current rising rate environment, higher yields can be achieved in a more risk efficient way by investing in instruments which are slightly down the credit curve, and in those buckets remaining or sticking to very high quality credits rather than chasing duration, because we believe that there is some more leg for this rate widening cycle to continue from here on. So I think given the paucity of time, I'll just quickly summarize that the fixed income market opportunity in India is quite big. We are seeing an increased amount of interest from non-institutional players in the fixed income market, which is leading to direct retail and HNI participation in the fixed income market, which was earlier rather indirect via mutual funds or insurance companies, etc. Bonds offer a variety of risk return profiles. One really needs to look at what and when and how much of risk appetite one has while and before choosing the right investment for himself or herself. Lastly, to summarize our view, in this current rising rate environment, we believe that higher yields can be achieved by going down the credit spectrum and sticking to high quality credits in the shorter duration rather than chasing duration to achieve the similar higher yields. So I think with this, I would like to conclude my talk and thank Equalify for this opportunity, and happy to take any questions after the session.
Hello. Yeah. Hello.
Yeah.
Yeah. So we will have to avoid the Q&A, Aditya, for now,
Sure.
because we're already
Sure.
running late. But
Sure.
thank you so much for joining in and for this quick informative session. Look forward to engage with you on slightly larger formats soon.
Sure.
Yeah, and we'll quickly move on. So thank you so much, Aditya, and have a great day. Audience,
Sure.
unfortunately, we do not have the time for Q&A. We'll have to move on to the next session. Our next speaker is already here. So Ashwin, can I quickly, you here?
Hey, hi.
Yeah, hi. 1 minute. I will give you the co-host rights. You have, I'm assuming you have some PPT to share.
Yeah.
Made you the co-host.
So let me know if the presentation is good.
Yeah, just a sec. Yeah, so it's visible. So audience, quickly getting into the last showcase session for the day, we have with us Ashwin Ramakrishnan, who's head of Altify. That's a interesting platform being set up by Northern Arc. Even I would love to know more from Ashwin on what they are trying to do through Altify, because having been into alternative investment education, and while the product industry started getting mainstream almost 6 to 7 years ago, but now is the turn for the platforms which can facilitate and democratize alternative investments. So hopefully Altify is an answer to that. But let's hear more from Ashwin. So Ashwin, thank you so much for joining in, and we have the audience here who's keen to know from you. I mean, unfortunately, we have 20. We had earmarked 20 minutes. Would like to keep that much. If we have some Q&A towards the end, we'll take it. Otherwise, audience can always reach out to you separately. Yeah.
So thank you so much. Thanks for the introduction.
Yeah.
Thank you so much. And thanks a ton for this opportunity. As you mentioned, I think a very interesting space, a very nascent space that's sort of evolving very rapidly. And as you also touched upon, I think largely delving on the fact that in terms of mindset, in terms of the different avenues that people are ready to look at while investing, what we've seen over the last few years is a sea change in terms of the different products that people are ready to invest in for achieving holistic financial planning solutions. A decade or so back, people were largely skeptical to go beyond equity and fixed deposits. Now, I think people are looking at investing on a holistic basis where they're looking at financial goals, how to achieve them in the best possible manner. And fixed income obviously plays a huge important role there, given the reduced volatility in comparison to equity instruments, as well as the higher interest rates and yields that it gives compared to fixed deposit products. So that's the genesis of Altify. And I'll just quickly walk everyone through how we sort of came up with the thesis and where we are, everything from the market and where the platform is right now. So yeah, just quickly, I think, a few earlier speakers broadly touched upon the market. Indian fixed income market obviously lagging behind some of the more developed economies. For example, if we take the US fixed income securities market is larger than the equity market and more than 2x their GDP. Compared to that, the Indian debt market is around say 60-70% of the GDP of India. And so there's a substantial scope in the growth there. And a large part of that is actually perhaps not due to demand for debt, but that's actually due to the supply. And that's perhaps because a large proportion of the population, large share of the Indian population does not invest directly in debt. It largely happens indirectly through mutual funds, insurance companies, and so on. So there's substantial growth opportunities in the overall fixed income market in the country. And if we just sort of narrow that down into the corporate bond market, if you look at, again, the United States, if you look at just debt issuances, that sort of doubled over the last 10 years. So we've seen substantial increase in corporate debt issuances there. And in terms of their overall share of outstanding debt as a country, despite the huge increase in the treasury debt over the last couple of years, I think as a percentage, corporate debt still accounts for a good 15 to 20%. In India, though, it's actually reasonably high. It's close to 25% of the total debt, but there are issues on both sides. In terms of the issuers, it's largely restricted to AAA securities. At the max, some of the higher and well-known AA securities. Beyond that, there's hardly any scope for issuers to tap into the debt markets. And similarly, on the investor side, I think what happens is that it's largely restricted to institutional investors so far. So be it mutual funds, pension funds, and so on. Retail investors or even affluent investors for that matter, very minimal participation in the direct debt markets. So what we've also seen is that nearly almost all the bond issuances, a good 98% of them, happen through private placements. So very limited opportunities, avenues for retail or affluent investors to take part in these in this very interesting asset class. Also, I think going forward, these are CRISIL estimates. We expect substantive growth of the corporate bonds in terms of over the next 3 to 5 years. And we expect that financial institutions especially are going to play a critical part in that growth story. They're expected to roughly contribute 1/4 to overall corporate bonds outstanding requirement. So this is where I think Altify's role sort of comes in. We're seeing a huge demand for these for incremental debt investments in the country, and we're not seeing enough supply. And which is obviously where platforms like Altify, where issuers can directly tap into the retail investor base, be it HNIs, affluent, mass affluent, and the retail investors as well. In terms of products, what we offer right now are bonds, and these are senior secured bonds, subordinated bonds. We offer a variety of MLDs and so on. We also offer shorter tenor products like commercial papers on the platform. So basically, a holistic fixed income platform for people to sort of look at the entire gamut of fixed income products. Largely targeting the wide spectrum of the market. We roughly see around close to 15 crore households in India who can be targeted through this product. Because if you look at the number of Demat accounts in the country, it's around close to 9 crore Demat accounts now. Whereas if you look at the number of people probably directly investing into debt instruments, that perhaps be less than 1 million. So compared to that, I think there's a huge growth opportunity there, which is what we're planning to tap. And the reason, obviously, people should consider fixed income products, especially the debt products that we're talking of, is what you're seeing on the screen right now. Inflation has sort of skyrocketed over the last couple of years, whereas if you look at FD rates across the major banking institutions, they've either plateaued or probably remained stagnant. So in terms of the value of money itself, I think investing in traditional products has actually just led to value destruction. While for example, if you look at a platform like Altify, we're offering securities that are sort of giving yields as high as 13%. And these are very curated securities that go through the entire diligence process where we have incentive alignment and so on. A lot of which I'll just touch upon subsequently. The requirement for diversification, very obvious, but just to restate that, I think in terms of equity markets, very volatile especially with respect to short term as well as perhaps medium term goal planning. Fixed income securities are a much better bet. What we just talked about, fixed deposits and the destruction of value by investing in them over the last few years or so. Why Altify? I think that's something we'll touch upon in the future pages as well. But I think in terms of yields, what we're offering is amongst the best in the industry. We offer securities that are curated as well. So both in terms of risk as well as returns, I think we're up there amongst the best. In terms of product profiles, we offer a wide range of products, and these include tax efficient products like MLD. And largely, all issuers on the platform sort of need to go through our stringent due diligence process, as well as our monitoring process on an ongoing basis. Just quickly on the platform itself, and just delving a bit deeper into the platform and what exactly we offer, right? So as of now, just in terms of metrics, we've done close to 200 crores of transactions on the platform. We have 2,000 registered users. And a good close to 90% of our users are actually repeat customers. So they come back for repeat transactions, just sort of giving an indication on how good the product profile is and how good our service levels are. This is obviously on a 1 month lag basis. So basically, this is on the June ending customer base. The number of transactions, number of customers who've done multiple transactions with us till now. So as I briefly talked about, we offer a wide spectrum of fixed income products across senior secured bonds, MLDs, commercial papers, subordinated bonds, and so on. Yields are typically around 8 to 13%. Unlike a lot of other platforms, the tenor here is very much on the shorter side. So anywhere from 2 months, typical CPs, 2 to 6 months kind of products. That's the kind of CPs that we have on the platform. To at the max around 3 years is where we go. So relatively shorter term tenor products, which sort of reduces the risk in terms of tenor and duration. Which also sort of reduces reinvestment risk in this market, and very curated securities as well. We've given a snapshot of the issuers that we have on the platform. Just to delve on that a bit further, each of these issuers are sort of onboarded by Northern Arc as part of its normal course of business. Northern Arc right now has around 8,000 crores of balance sheet AUM, a total AUM of around 11,000 crores. I'll just talk about Northern Arc briefly as well going forward. But in terms of the due diligence process that goes in while each of these issuers are onboarded, apart from the typical desktop diligence that happens with most lenders, including financial analysis, operational analysis, portfolio analysis, look at the corporate governance structure, the promoters, the professionals who are running it, the shareholders, as well as systems and processes. What typically happens is that both at the time of onboarding as well as on a regular basis post onboarding, while we have exposure to these securities, we do a complete portfolio review periodically through our proprietary risk models and our in-house risk analytics team. What we also do, and this is what really differentiates us from most of the lenders and investors in the country, is that we have a huge risk monitoring team that sort of goes on the ground, visits not just the management of the company, but also branch level employees, goes and meets the end customers, especially where we believe that there are sort of pockets of stress emerging. This can be, say, for example, social stress coming up, political stress. If it's say MFI related, it could be say typical geography related stress, or if it's say MSME related, specific sector related stress. So generally amongst all lending institutions, we're amongst the first to identify some of these stress points. We sort of make sure that we identify these stress points at the earliest and take corrective actions immediately. So in terms of both diligence at the time of onboarding as well as on an ongoing basis, we make a complete thorough effort there. Also, there's substantive incentive alignment. So unlike other platforms which follow a sort of typical platform kind of an approach, we generally have and maintain an exposure to these entities, mostly to these securities themselves, if not to these securities, at least to the entities in some other form or manner, while we sell these products down to retail investors. That sort of gives a huge incentive alignment, a skin in the game for us. And also, I think I broadly touched upon the product suite here. So we have we start from AA securities and go all the way down to new and upcoming companies, which are perhaps not rated yet, but which have raised a bunch of equity in the recent past and are sort of, at least for the short term, well covered, well capitalized, and so on. So in terms of that, obviously gets sort of reflected in the kind of yields that are offered as well, and in the form of a risk-adjusted returns basis, significantly positive for investors looking to invest. Just in terms of historical track record, Northern Arc, we've disbursed close to 15,000 crores of balance sheet facilities over the last decade or so. And out of that, we have a total loss book of close to 200 crores. So that's like roughly around 0.15%. So for securities that are sort of typically yielding anywhere between 9 to 13%, that's the kind of historical loss record that we've encountered. Yeah, just so Altify is basically the investment platform of Northern Arc. So Northern Arc is an NBFC registered with the RBI. I'm assuming most of you perhaps know about the entity, but just quickly, taking everyone through it. Close to 6 crore retail customers are sort of facilitated through Northern Arc's funding. We work with close to 400 originator partners across the country, largely across the country, across 35 states, more than 650 districts. And the kind of losses that we've seen over the last decade or so, as I mentioned, amongst the best in class. Backed by reputed shareholders, SMBC, one of the world's largest banks, the world's 14th largest bank, in fact, and Japan's second largest bank. They own a stake in the company. Eight Roads, which is Fidelity's proprietary investment arm, is a shareholder. So is IIFL and Affirma, which was earlier Standard Chartered Private Equity. Leapfrog and Axion are impact investors, global impact investors. Yeah. And just in terms of the overall business of Northern Arc, over the last decade or so, close to 400 partners across sectors like microfinance, MSME finance, vehicle finance, housing finance, and so on. A large, and we've sort of developed tremendous expertise in each of these sectors by underwriting them over the last decade or so. And that's sort of reflected in the products and securities that we originate and put up on the platform. So that's quickly a snapshot of the Altify platform. Any questions, happy to take them. And yeah, it's altify.ai. So would love all of you to just have a look at it, and you can probably reach out to me at any time in terms of any feedback, questions, and so separately as well, apart from what you have now.
Sure, Ashwin, thank you so much. So I'll have to. I'm afraid we'll have to keep the questions for some other day. Maybe we can have as I've promised to almost every speaker today, we'll probably have a standalone session very, very soon with you, because as we're running behind schedule. But thank you so much. And it was wonderful listening about Altify. And I'm sure with this also, you guys will set up some new benchmarks. So this looks very, very interesting, what you're trying to achieve. And our best wishes for you and your team.
Thanks for the opportunity.
Great. So, audience will quickly move on to our last session of the day, and one of the most anticipated ones, especially when it comes to Joydeep joining us to teach about fixed income investing. So, for the next 1 hour, we're going to have a quick masterclass from one of the very well-known exponents of fixed income investing, Mr. Joydeep Sain. Joydeep is one of the most respected names in this space, has a very illustrious track record. Of late, he's been a very prolific trainer, an author, and wears multiple hats. So Joydeep, thank you for joining in and taking your time for this quick session, masterclass for our audience. Do you have a PPT that you'd like to share?
Yes. So first, Aditya, thank you so much for the wonderful intro. I owe you a coffee for this.
Thank
Yes.
you. Thank
so you have to make me the
it's
co-host.
wonderful. It's wonderful working with you as always. So,
Yeah.
and I've been in the part of a lot of knowledge sessions with you, so I know the way audience also kind of reacts to your learning sessions. So, thank you. And we couldn't have asked for a better concluding session for today's fixed income segment. And now I'll not want to be between you and the audience for long, so I'm quickly handing over the mic to you. Yeah, over to you. So you are aware of the format, Joydeep, and unfortunately will not be able to take too much Q&A. Audience, we're coming up with a complete full-fledged batch on fixed income investing. We've been holding this executive program with Joydeep for last couple of years. So I'm sure Joydeep will talk more about that. That is coming up next month. So if you wish to learn this in depth, then do join in for that. For now, I think savor the quick tips and insights that Joydeep will give you. So Joydeep, over to you. We've got another 50 odd minutes for the session before we wind up.
Sure. So I will start with sharing my PPT. Just give me a minute to share. Yeah, is my screen visible?
Yes, it is.
Yeah, so I will enlarge this so it is easier for participants. Sure. So to start off, the topic given is innovation. And talking of innovation, it is kind of challenging. The reason being in a market where there are so many evolved participants, whatever is worth covering, discussing is already kind of covered in various media, social media, various reports and forums and discussions. So what I thought is let me try my best to present something which is different from the daily routine, the daily mundane stuff, and talk of something little different in fixed income, which you may have been otherwise hearing in various platforms. So the most often discussed thing is RBI rate hikes. So for quite some time, must have been hearing about RBI rate hikes, what they did last Friday, and all those things. And the question now is how much more? How much more will the RBI hike and all those things? And the generic market view, the consensus view is that the terminal rate meaning today's repo rate being 5.4%. At the end of the rate hike cycle, maybe till December this year, maybe till February in 23, February next year, the terminal repo rate would be something like 5.75 or 6% or thereabouts, depending on RBI's reading of the situation. But the point is, whatever has been happening and whatever may happen is already priced in. The market knows it. Just to give you a sense of why I say this, that the market knows this. When did the RBI start or formally start the rate hike cycle? So on 4th of May this year, RBI did an unscheduled rate hike. Suddenly out of the blue, they did that, 40 basis point. So repo was 4, it became 4.4% on that day. Today it is 5.4%. And just go back a little bit. On 3rd of May or even 4th of May morning, what was the 10-year benchmark government security yield? It was like around 7.1, 7.15, 7.12% thereabouts. Today, how much is it? 10-year benchmark government security is like around 7.3, 7.35% or thereabouts, which means from 7.1, 7.15 to 7.3, 7.35. How much has it moved up? By approximately this much only, maybe say 20, 30, 40 basis points only. Whereas from 4th of May till today, RBI has formally hiked the repo rate by as much as 1.4%. So why this difference? Why this dichotomy in market movement? Because it was already priced in. The market already knew that rate hikes are about to happen. Yes, on 4th of May morning, the market did not know. It came as an unscheduled this thing. But broadly, if you look at the market movement from earlier, the market already knew it and the market had already priced it in. So when I say already priced in, I will just present one chart here, one data point. Look at this. This is a very long period thing starting from 2001 till date, almost till date, little old, almost till date. What this shows is the spread or the differential between the 10-year government benchmark government security yield and the RBI repo rate. As a 20-year history, this spread is approximately 1%. So as an example, if the repo rate is say 5% and 10-year benchmark G-Sec yield is say 6%, then the spread is 1%. 21-year history, that average is approximately 1%. And go back a little bit, just prior to the unscheduled RBI rate hike on 4th of May, what was the repo rate? It was 4%. And 10-year benchmark G-Sec as on that date, as I said, it was like 7.1, 7.12%, which means as on that date, it was more than 3%. Just imagine, 21-year history, 1%. As on that date, it was as much as more than 3%, which means the market had already priced in, even though 4th of May as a date came as a surprise. Even today, look at it. Look at what's happening in the market and where the market stands. Today, repo rate is 5.4%, 10-year benchmark around 7.3, 7.35%. So almost 2%. So against the historical average of 1%, today it is 2%. So even today, the market has already priced in. So what does it mean for us? What it means for us is from now on, yes, the RBI will hike rates. Anybody's call how much? So from 5.4, it will go up to 5.75, maybe 6%. People are saying mostly around 6% will be the final terminal repo rate at the end of rate hike cycle. But in response to whatever the RBI does or does not do, the market will not react as much. So like I just said, from 7.1 to 7.3, the market has moved only this much, whereas the RBI has hiked by as much as 1.4%. So from now on, whatever further rate hikes the RBI does, market will react, but not as much. The reaction will be less than commensurate. So maybe sometime earlier we saw 7.6% of 10-year. It may have peaked out there, or maybe we may see another bout of whatever, if inflation gives a negative surprise, or there is additional government borrowing in the last quarter of this financial year or something of that sort. But otherwise, it is mostly priced in. So while RBI rate hike is, of course, a relevant discussion, how much the market is likely to react, that also is relevant. And as we said, it is already priced in. Now I come to my next funda, the cost of waiting. So over this entire cycle, the market positioning itself for potential rate hikes over the last 1 year, 2 years, 1.5 years, the market has been positioning itself for potential RBI rate hikes, which finally started on 4th of May this year. In this entire hike cycle, or the market adjusting itself cycle, you would have heard everywhere that don't go for long bond funds, which is correct. Go for short bond fund or liquid funds, whatever, be in defensive debt funds, which is correct. The logic is this funda of maturity and duration. So longer the maturity, longer the duration, the higher is the multiplier. Multiplier means whatever is happening in the market, interest rates going up or down, whatever. What is the corresponding reaction, the corresponding impact on the price and on the NAV of your debt fund holding? That is the multiplier. So if you're in a long bond fund with a portfolio maturity of say 10 years, with a duration of say 6 years, the multiplier is 6. If you're in a short bond fund with a maturity of say 3 years, with a duration of say 2.75 years, your multiplier is 2.75, less than that. If you're in a liquid fund with a maturity or duration of say 1 month or so, your multiplier is 1/12, so that much lesser. So if you're in a defensive fund, the impact is that much lower, which is correct. However, in this entire discussions of being in a defensive fund and not taking a call on longer bond funds and volatility and all these things, one point tends to get missed out. And that point is the cost of waiting. And what is this cost of waiting? The more you go in a defensive fund, as an example, if you go in a liquid fund, your accrual level, which is the portfolio YTM net of expenses, your accrual level is that much lower. And in a usual regular kind of fund, regular bond fund, usual bond fund, the accrual level is higher. So while yes, on one hand, you are settling for a lower volatility and you are being impacted less when yields are going up, the market is adjusting itself and all that. You are also missing out on the higher accrual of the usual other bond fund. So I will show you one illustration to illustrate this cost of waiting. And this cost is the opportunity you are missing out by not being in a usual debt fund with a higher accrual or a higher YTM or net of expenses YTM. So now look at these numbers carefully. So I have taken a scenario where there is one liquid fund. Now the portfolio accrual I have taken is 3.5. Now it is much higher. So I did this illustration a little earlier when the accrual level of liquid funds was lower. Now after the RBI rate hikes, money market yields have moved up. But for the sake of calculation and illustration, let's say in a liquid fund, the accrual level is 3.5%. And while in a liquid fund also, there is a very nominal mark-to-market impact. I'm assuming it as 0 for the sake of simplicity, for the sake of understanding. Liquid fund, accrual level 3.5% and modified duration 0, or impact of market movement is 0 for the sake of simplicity. And there is another usual conventional debt fund with an accrual level of 6%. Let's say net of expenses 6%. Portfolio maturity 4.5 years and modified duration 3 years. So here 3 is the multiplier. Liquid fund multiplier is 0, as in whatever is happening in the market, yields going up, down, whatever, it's not impacted. Another usual fund with a net accrual of 6% and modified duration of 3 years, multiplier is 3. To understand this cost of waiting, let us say interest rates will move up over the next 6 months by 50 basis points or 0.5%. It's an assumption only. No one knows what will happen, but as an assumption, interest rate moves up by 50 basis points over the next 6 months. And after that, it does not move up. And your horizon is, say, 1 year. So what can you do? If it is a given that interest rates will move up by whatever, 50 basis points over 6 months, and it will stay put in the next half, second half of the year, conventional wisdom is you wait in the defensive liquid fund and don't go for the high volatility fund. So what is your return? That will give you the cost of waiting. So one option is you wait in the liquid fund for 6 months, then move to the usual conventional bond fund, or invest in the conventional bond fund on day one itself. That is the other option. So let's see the workings. Return scenario over the next 1 year. In the first option, in the liquid fund for the first 6 months, how much accrual do you get? You get an accrual of 3.5 by 2. So 3.5 is the net YTM, and 6 months, so divided by 2, 1.75. And over the 6 months, rates have moved up. So the accrual level of the bond fund, which was 6% earlier, moves up to 6.5%. And over the next 6 months, the second half of the year, your accrual is 6.5 by 2, 2 as in 6 months, so divided by 2, 3.25. So how much do you earn over 1 year? 1.75 from liquid, 3.25 from this usual conventional bond fund. So you earn ₹5 per ₹100. Okay. What is the other option? Other option, which was not recommended, invest in the bond fund straight away, knowing fully well that interest rates will move up. So over the first 6 months, the accrual is 6 by 2. We start with 6. Sorry, 6 by 2. So 6 is the accrual level, and 6 months that way divided by 2, so 3. So the modified duration, the sensitivity, the multiplier is 3. So the impact is 0.5 into 3. So interest rate moves up by 50 basis points, 0.5%. So that into 3 is the impact. So 1.5. So effective return for the first 6 months is 3 accrual minus 1.5. So 1.5 is the net return in the first 6 months. Next 6 months, accrual moves up, 6 becomes 6.5, 6.5 by 2 is 3.25. So how much do you earn? Is 4.75. So now think of it. In the earlier option, yes, you wait out in a defensive fund, you earn 5. In the second option, you invest in the bond fund straight away, and you earn 4.75%. It is lower, but only so much. That is the point. It is not like heaven and hell difference. And now the crux. For a fund with a portfolio maturity of 4.5 years and modified duration of 3 years, your horizon should be at least 3 years. So assuming there is no further interest rate up move over the year 2 and year 3. So you earn 4.75 year 1, 6.5 and 6.5, so 5.9%. So you started off with a 6% accrual, net accrual. Over the first 6 months, interest rates do move up and you are impacted adversely. After everything, you earn 5.9%. So as and when interest rates move up, the accrual level also moves up. So the message is what is required is a holding period. As long as you have an adequate holding period, you are safe. So to combine the first point and this point, first point was what? It is almost already priced in, little bit still left, but mostly priced in. And second part, if you have the horizon, don't have to worry as much about the interim market volatility. So from now on, given that the market will not react too much, while there is no problem in waiting in a defensive fund, it is kind of okay as long as you can handle your clients, the psychological behavioral aspects. You can straight away go to your intended fund. If it's target maturity fund, the portfolio accrual. Even if it's a usual fund, like be it banking PSU, be it corporate bond, be it short duration, depending on horizon, you can go into those funds also. Okay. And as we just said, the accrual levels have moved up. So as an example, I have taken a target maturity fund. The reason is, indexation is available to any debt fund, be it liquid, be it FMP, be it target maturity, be it the usual, corporate bond, banking PSU, long bond, short bond funds. In a target maturity fund, you have a higher visibility. So whatever the portfolio YTM is today, as long as you hold till maturity, it can be a little bit of unis here and there, but you'll get more or less something around that. So as an example, if it is a 5-year maturity, target maturity fund, the YTM is so much, and the expense ratios in these funds are very nominal. So it is a client-oriented product, not so much for the advisors, but as an example, I'm showing you this thing. There are other funds with a reasonable expense ratio and a reasonable payout also. So 740, so 5 years of indexation. So of course, it depends on the inflation which actually happens, what is given by the government, but net, assuming 5% inflation over a holding period of 5 years, and starting with a net YTM of say 7.4%, what is your final return? Approximately 7%. So depending on so many factors, like how much is actual inflation, how much is given by the government, you get about 7-ish return. Why is this important? If you look at the last 1 year, 2 year performance of debt funds, it is muted. And clients would be coming to you with this from this perspective, that last 1 year, last 2 years, debt funds ne kuch nahi diya, and that kind of thing. Yes, it is a fact. Last 1 year, 2 years have been muted. But the reason for that is yield levels have been moving up. So as you're aware, the accrual of a fund, debt fund, is always there. When yields are moving up, that takes away from the accrual. And when yields are coming down, prices are going up, that adds to your accrual. So last 1 year, 2 year, yields have been moving up. So your returns have been muted. But in the process, the accrual level has moved up, which is there. Where can you see this? You can see this in the YTM. Look at the YTM of debt funds 1 year ago, 2 years ago, and look at the YTM today. There is a significant uptick. Let's say 1% as an example. So this 1% higher YTM, which is there today than earlier, that will lead to higher returns. And if you ask me when, the answer to that when is when market settles down. So when the market reads it as the RBI is done or almost done with rate hikes, market will not react much. That is when the higher accruals will bear fruit. That is about debt funds. Now, I will move on to other topics now, because debt funds are more or less already covered. Or if you have any query about debt funds, as Aditya mentioned, we'll have a session maybe sometime in September, and that will be more interactive. I will talk of certain other products in the fixed income space, because the topic given is innovation. So there are things which are little hatke, which as financial advisors you can offer to your customers. One is this tax-free PSU bonds. Now, what is this tax-free PSU bonds? Only certain select PSU undertakings, PSU companies can issue these bonds. So how did these bonds come into effect? When the bonds were issued earlier, the finance minister in the budget speech would announce that in this financial year, up to so much of tax-free bond issuances would be allowed. And subsequently, they would issue a notification that these particular PSU entities are being allowed up to rupees so much per entity for issuance of tax-free bonds. And over a period of time, within the financial year, of course, these issuers will one by one come to the market with their issuance. Now, this kind of issue happened as early or as old as February 2016. So over the last 6 years or so, there has not been any fresh issuance of these tax-free PSU bonds. So whatever is there in the market today is outstanding issuances. So whatever issues happened earlier, that stock is there in the market, but nothing is being added to that stock. So you will recall that the issuance yield, the coupon rate of these bonds are like 8%, 8.5%, 8.2%, and thereabouts. Sometime earlier, due to rally in the market, the yield came down to as low as 4%. Today it is like 5%, 5.5%. Yield levels have moved up. The rally which happened from 8% to 4% is of course driven by RBI rate cuts and all those things. But another reason is there is no fresh supply. It is only the existing stock which is being chased by the market, and that factor will be there in the market at least for some time. There is no visibility of any fresh supply of these tax-free PSU bonds. So how does it work? The coupon obviously is tax-free. Yes, there can be a capital gains tax. If you buy this bond at a certain price and you sell in the market prior to maturity, secondary market, and if you make a capital gain, that is taxable as capital gain. So for capital gain for bonds, there is no indexation. If your holding period is more than 1 year being listed, it is long-term capital gain, 10% plus surcharge and cess. If your holding period is less than 1 year, it is short-term, HTCG, which is your marginal slab rate, 30% plus surcharge and cess. Now, for comparing these bonds with other similar quality, good quality bonds, there is this concept of tax-free equivalent, because in the other usual taxable bonds, the coupon which you get is taxable at your marginal slab rate, which is 30% plus surcharge and cess. So for comparison purposes, whatever yield you are getting in this bond, 5%, 5.5%, that has to be grossed up to the tax-free equivalent for comparison with other bonds. So as an example, if your tax rate is 30% only, ignoring surcharge and cess, and you're getting an yield of 5.4%, then the pre-tax equivalent is 5.4 divided by 1 minus 30%, so it is 7.7%. So the question is, are you getting 7.7% yield in other good quality AAA rated PSU bonds? So as we just discussed, for listed bond, holding period is 1 year for capital gain, for long-term capital gain, 10% plus surcharge and cess. And for less than 1 year holding period, listed bond, it is 30% plus surcharge and cess. These are the issuers, obviously all PSUs, and you see all are triple, except one issuer, IRIDA. All are AAA rated PSUs, so premium grade quality. So who should invest? HNIs, people in the higher tax bracket, and these are good quality AAA rated PSUs. Now look at these numbers, depending on your tax bracket. So if you are less than 50 lakh, your tax rate 30%, surcharge says 31.2%. So if you're getting 5.4%, the gross stock equivalent is 7.85%, which is good. Next bracket, 50 lakh to 1 crore, your surcharge goes up. Tax rate is 34.32, gross stock is 8.22%. You won't get this much of yield in other good quality AAA rated PSU bonds. At the highest tax slab for income more than 5 crore rupees per financial year, your tax rate is 42.74%. Tax rate as such 30%, surcharge so much, and cess 4%, it adds up to this much. And at that level of taxation, the pre-tax gross stock equivalent is 9.43%, which will not get, it's impossible to get in a good quality PSU bond. You will get 10%, 11% in other, maybe say AA or single A rated bonds. Now, to clarify, this is not to be confused with the mutual fund thing here, because in mutual fund debt, mutual fund, you have indexation. Indexation is not available for bonds. Indexation is available for bond funds only. So this is different. If you invest in a debt mutual fund, any fund, be it FMP, be it target maturity fund, be it the usual debt funds, be it a liquid fund, long bond, short bond, whatever. So your return becomes that much more tax effective. Whereas in bonds, there is no indexation. So this concept of comparison is with other bonds which are taxable at the marginal slab rate. Another product which you can do in the fixed income space is market linked debentures. So market linked debentures can be equity oriented, can be fixed income oriented. So in an equity oriented MLD, there is an actual linkage to the market. Market meaning can be Nifty, can be Sensex, can be single stock, can be basket of stocks, whatever. Actual orientation in the market. So you may have a 75% market participation, 100% participation, whatever, depending on the terms of the product. To whatever extent market moves up, you get a participation in that. But there are fixed income oriented structures. The linkage can be to anything. Can be to 10-year government security, can be to gold, can be even to equity, Nifty, Sensex, basket of stocks, whatever. In a fixed income oriented structures, even though there is a linkage, the linkage is kept in such a manner, the conditionality, the optionality, the condition is kept in such a benign manner that for practical purposes, the investor knows ki mujhe kitna milega upfront. That is how it is designed. So fixed income oriented MLDs can be positioned to fixed income investors or for the fixed income component of a portfolio. So what are these MLDs? So market linked debenture. Ultimately, it is a bond or a debenture only that instead of there being a defined coupon like 6%, 8% or 7%, there is an underlying condition like 10-year benchmark government security price being more than so and so, or Nifty being more than so and so, or whatever. The condition is kept in such a vague manner that practically in a fixed income oriented structure, the investor knows how much return he will get over the holding period. What is the USP of this thing called MLD? The USP is taxation. So how does it work? There is a maturity date given, and prior to maturity, there is a crystallization date given, where the underlying condition like 10-year GSEC or Nifty or Sensex, whatever, that will be observed, and they will formally announce that this much is your return. Whereas in a fixed income oriented structure, even though initially you know it, for the sake of records, they will do all these things. This thing called MLD is in a way similar to zero coupon bonds. In the sense, zero coupon bonds, there is no defined coupon. However, in a zero coupon bond, it is defined upfront that issue price so much, maturity price so much, like issue price 70, maturity price 100, you know it. Whereas in a MLD, the condition is kept in such a manner that there is this thing, whatever, conditionality or optionality or uncertainty or vagueness built into it. Why do all this rigmarole? For tax efficiency. Because officially, the investor does not know how much return he will get over the holding period. So there are market-linked debentures, which are principal protected, which means whichever way the underlying condition moves, your principal, like initial 100 rupees of investment, that is protected. You will get that back on maturity, irrespective of the movement in the underlying market. And there are non-principal protected MLDs also. Now, that tax efficiency, the 10% taxation is available only for principal protected MLDs, because only principal protected MLDs can be listed. And that taxation thing, which I just said, listed bond holding period 1 year qualifies for LTCG, long-term capital gains tax, which is 10% plus surcharge and cess. So only PP structures can be listed. So in the market, there are non-PP structures also. So principal guaranteed means irrespective of the underlying condition that GSEC or Nifty or whatever. And yes, you may get upside of equity also depending on the product. Can be equity oriented products also, can be fixed income oriented products also. And in a non-PP structure, you're open to the market movements. So I told you what is PP. So what is the taxation? This product is put to tax as holding period of 1 year. Listed. I'm talking of, there are unlisted ones also in the market. I'm talking of the listed ones. 1 year holding period eligible for LTCG. So this is put to tax at 10% plus surcharge and cess. Now, if you go strictly by the rule book, zero coupon bonds are taxable as interest at your marginal slab rate. But here, what is happening? In a way, it is similar to a zero coupon bond because there is no coupon flow. In a way, it is different because initially it is not defined what is my maturity price. There is some conditionality, some observation, and all those things. And prior to maturity, this product is sold off as a secondary market transaction. So from the investor's point of view, he is buying something at rupees 100, and prior to maturity, it is being sold off at whatever that price is, rupees 120, 130, 150, 125, is being sold off. The differential is kind of capital gain because there is no coupon for the interim, and officially the investor does not know initially what the return will be. So it is put to tax as long-term capital gain, which is 10% plus surcharge and cess. And that is the USP. And that is why this product is very popular in the HNI space, because in the HNI space, taxation is a sensitive issue. It is popular in the HNI space only, not in the corporate space, because in the corporate space, there's so much of taxation, there's so much of audit and scrutiny and all those things. So they cannot really go for all this. Whereas for an individual, HNI or retail or whatever, there is no answerability to anybody as to what you have done or why you have done it. It is between the CA and the investor. So this we have discussed. So it's called payoff. In a usual bond, it's the coupon. In a zero coupon bond also, the differential between the issue price and maturity price is the conceptual equivalent to a coupon, though technically there is no coupon. And here it is called payoff. That I buy something at 100, I solely talk in a secondary market deal at 120, 130, 150, 125. That is called the payoff, which is put to tax as a 10% plus surcharge and cess. So this gives you a comparison of this thing and to show you the perspective where this thing stands. So as an example, in a AAA conventional bond, good quality bond, if you get 7.5%, depending on tax bracket and effective tax rate. So if you're in this bracket, 1 to 2 crore, 35.88 is your tax rate. Then on 7.5, you get 4.8%. If it is a tax-free PSU bond, and if you're getting say 5.4%, assuming there is no capital gain, assuming you hold till maturity only, you get coupons only, which is free of tax. So 5.4 is 5.4 only. So this is higher than this other bond of 7.5%. Then this thing, MLD, as an example, if you get 8.2%, obviously not AAA, it will be a AA kind of variety, or maybe single A also. But yes, AA rated MLD, 8.2 is possible. And decent names. So 8.2 taxable at 10% surcharge says 11.96, you get 7.22. So this is the attraction of MLDs in the HNI space. Tax efficiency leads to significant effective hike in returns. Bank 81s I'll cover just now. So as an example, if you're getting say 7.75% in the bank 81 bond, depending on your tax bracket, that becomes 4.9%. And bank FD, yes, it is taxable at your highest slab rate. So depending on whatever rate you're getting, assuming 5.75, this becomes 3.69%. So this gives you a perspective on the fixed income products. Mutual fund, yes, mutual fund, as long as you hold for 3 years or more, depending on the indexation given, your effective tax rate becomes much lower, less than 10%. So mutual funds are tax efficient. So whatever it like I showed you earlier, if you're getting say 7.4% net of tax over a holding period of more than 3, I get like, depending on indexation, you get like 7%, which is of course very efficient. So debt mutual funds, tax efficient, MLDs, tax efficient. What is the downside of MLDs? The downside of MLDs is secondary market liquidity. Mutual funds, very liquid, you redeem, you get back your money apart from the lock-in products and apart from FMPs. Very easy liquidity. Good quality bonds, AAA bonds, you can sell in the secondary market, but MLDs, secondary market, it is not liquid. That transaction prior to maturity is organized as a service by the service provider as a one-time effort. So this product called AT1 PERP. So what is this thing? AT1 stands for additional tier 1 and PERP is perpetual. So as a regulation, banks, as part of their capital adequacy, 1.5% of the capital. So as per regulation, as per RBI, it is minimum 11.5% of capital adequacy. So of this 11.5%, 1.5% has to be issued as perpetual bonds. So there is one CET, that is common equity capital, CET1, which is simply equity capital. Then there is additional tier 1, which is this product, this variety, 1.5%. So 8% of minimum equity and another 1.5 becomes 9.5. And then tier 2 capital, which is 2%, becomes 11.5%. That is the requirement. So all banks or most banks have a bond in this category, additional tier 1 bonds. What is the risk in these bonds? There are two risks. A bank can service the coupon of these bonds only if they're in profits or there are certain defined reserves, which simply means if the bank is making losses, they may not pay the coupons on their additional tier 1 perpetual bonds. And yes, they're very big risk of write-off. So as we saw in the case of Yes Bank, 8,415 crore of bonds, 81 bonds entirely written off. That risk is there. But yes, sometime in 2018 and 19, when PSU banks were writing off their losses and they were suffering losses, this condition cropped up, that these loss-making banks, this PCA, prompt corrective action, these PCA banks, PSU banks, can they service their coupon? So what the government did, government or RBI, what they did is, they allowed these banks to prematurely call back their 81 perps even before the call date. So call date in 81 perps under Basel III is 5 years from the date of issuance. So even before 5 years, all these were called back and settled. So that is one saving grace in this product. So what are the accidents? One is Yes Bank, and then Lakshmi Vilas Bank happened, and Lakshmi Vilas Bank was actually tier 2, which is supposedly less risky than tier 1. But yes, that also the RBI did. So what are the features of this product? There is a call option 5 years from the date of issuance, and it trades in the market as a 5-year product. Even though technically these are perpetual bonds, call option is only an option with the bank, with the issuing bank. It is not a condition for them to call it back. And after the Yes Bank incident, there is one SEBI circular. So a lot of text on your screen. I'll tell you simply what it means is, fresh issuances after October 2020. Fresh issuances, minimum ticket size 1 crore, and in the primary issuance, only QIB, that is qualified institutional buyers. Only QIBs can subscribe, not others. So this is the text of the SEBI circular. So the interpretation is that old stock meaning additional tier 1 bonds outstanding prior to October 2020. On those trade lots can happen. 10 lakh, 20 lakh lots can be traded. But for fresh issuances after October 2020, the minimum listing by definition becomes 1 crore and multiples thereof. So that is one issue in 80 perpetual bonds. But yes, 81 bonds are recommended. I do recommend 81 bonds. People come from the perspective of the accidents like Yes Bank and all. But the point is, just because Yes Bank has happened, we cannot say the same thing will happen to, say, as an example, SBI, or same thing may happen to HDFC Bank, because SBI is SBI, HDFC Bank is HDFC Bank. What happened to Yes Bank cannot happen to SBI or HDFC Bank. So accordingly, you can take your pick, and if you're okay with the, what should I say, calculated risk, you can take a bet in these 81 bonds also. The credit rating of these bonds is 1 or 2 notches lower than the other usual bonds of the same issuer. So even banks like, say, SBI or HDFC, which are otherwise AAA, these 81 bonds are rated AA plus, not AAA, because of these 2 risks: coupon discretion, as in they will pay coupon only from profits, and this potential write-off. So 1 or 2 notches lower is the credit rating. Some examples you can see on screen. And this is old data, Feb 21, but it gives you a perspective. We have approximately 1 lakh crore outstanding. If you can see the last this thing, approximately 1 lakh crore outstanding of this variety, additional tier 1 perpetual bonds. So that's about my presentation. So what I will do is, since there is no live interaction, I'll summarize the whole thing, what we discussed. So as of today, where we stand, our inflation is high, 7%. And for inflation, the RBI tolerance band is 6%. And as long as inflation is more than 6%, RBI has to act. However, the message from the RBI, the members of the MPC, the Monetary Policy Committee, the message is, it is not just today's inflation, but forward-looking inflation 1 year down the line. So last Friday itself, what the RBI projected on inflation, their call is last quarter of this financial year, which is Jan to March 23. Inflation call as an average is 5.8% in that quarter, which is less than 6%. And the quarter after that, which is April to June 23, RBI call is as low as 5% because there's a positive base effect. So when we look at 5.8% in Jan, March 23, we look at 5% in April, June 23, inflation is expected to ease going forward, which means from now on, yes, RBI will hike rates, but not as much. Maybe 6% would be the peak of RBI repo rate. And secondly, the market has almost already discounted, like we said, the differential between the repo rate and 10-year GSEC. 10-year GSEC is not the be-all and end-all, but yes, it's a good indicator or most popular indicator of how things are moving or how things are likely to be. So going by that, against the historical average of 1%, even today, we stand at around 2%. If we take 5.4% of repo rate and 10-year GSEC around 7.35%, it's almost 2%. So market will react, but not as much. So instead of, like we saw the cost of waiting, instead of waiting in defensive funds, you can simply pick and choose your fund category depending on your horizon. Target maturity funds, it has a very high visibility. There is a portfolio item, you can look at that, or even other usual funds, be it banking PSU, be it corporate bond, be it short duration, be it money market. Look at the portfolio maturity, the strategy of the fund, what is likely to be the portfolio maturity, the portfolio duration. Nothing hard and fast, but as a ballpark, the ballpark is whatever the portfolio maturity is. If we have an investment horizon equal to that, or maybe near to that, nearly equal to that, you're kind of okay. As an example, if 3 years is the portfolio maturity of a short duration fund or a corporate bond fund or a banking PSU fund, if we have a 3-year horizon which is required also for tax efficiency, you're kind of safe. If not exact 3 years, if you have a horizon of say 2 years also, that would be sufficient. So depending on your horizon, you can simply take a plunge in the usual debt funds also. Yes, there can be some volatility still, depending on which way inflation is going, all these things, crude oil and all those things are moving. But yes, mostly we are done with that. And on products, you know it, there are so many products in mutual fund space. There are those 16 debt fund categories which you can offer to your customers. Even within the usual stuff, there is some innovation like roll down. Roll down means with every passing day, the residual maturity of the fund is coming down. What happens in an FMP? If it's a 3-year FMP at the time of issuance initially, with every passing day, the remaining maturity, the residual maturity is coming down. Target maturity funds, again, there's a defined maturity date. So with every passing day, the remaining maturity, the residual maturity is coming down to that extent. There are certain usual open-ended funds also positioned by the AMC as maturity roll down. The significance of maturity roll down is, since the remaining maturity is coming down with every passing day, your volatility risk also is coming down to that extent. In the sense, if initially the maturity is 3 and duration is at 2.75, multiplies 2.75. After 1 year, if the maturity is say, not if it is 2 years only, after 1 year, if the duration is say 1.8 or 1.9, your multiplier is that much lesser. After 2 years, maturity is 1 year, if duration is say 0.9, your multiplier is less than 1. So progressively, you reduce your mark-to-market volatility risk. That is the significance of maturity roll down, which you can do through target maturity funds, through FMPs, through the usual variety and all that. Even otherwise, like we said, if you have an investment horizon, which is more or less equal to the portfolio maturity of the fund, you are kind of safe. Why so? One is the accrual. If you're in a fund for 3 years, you have the accrual for 3 years, not just for 1 year. So like we said, 6%. If you're there for 3 years, you get 6% into 3. The significance is the accrual is that much higher to take care of market fluctuations. And then over a longish horizon, RBI is hiking now. Next 6 months, maybe till February next year, RBI will hike. Thereafter, there will be a pause. And after that, somewhere down the line, 1 year, 2 years, 3 years down the line, situation will change depending on the way inflation and all those things move. There is a possibility of rate cut also. So as of now, it may sound like whatever, outlandish. but that is possible. Not today, after 1 to 3 years, whenever the cycle changes. Cycles will change. So as long as you have an adequate horizon, you can offer the usual debt funds also to your clients. And then we have these fixed income oriented products, the usual taxable bonds, the tax-free PSU bonds, MLDs, and 81 perps. The only thing which you have to keep in mind that the bond house you're working with, there would be a requirement of a minimum ticket size. So while there are certain bond houses which work on a retail level also, as in lot size of say whatever 50,000 rupees or 1 lakh rupees, they will have to keep margins adequate for them to make up their overhead costs and manpower costs and have a margin and all those things. Otherwise, if you want to work with a bond house who is keeping only a reasonable margin for themselves, then the lot size, the ticket size has to be adequate. So it depends, depending from bond house to bond house, 10, 20, 30 lakhs, whatever they are specifying. So it won't be a very retail kind of ticket size. All these things for a reasonable deal on it, be it a tax-free PSU, be it a taxable usual bond, be it MLD, or be it 8 up. Now there is a 1 crore defined size for fresh issuances. So it is a HNI kind of law. So depending on your client base, if you have a mix of HNI and retail, you can showcase these, what should I say, direct product. Direct as in not through the mutual fund route, but the product itself. You can showcase these direct products also to your customers. And of course, mutual fund is there for everybody, which is the most popular vehicle for investments in fixed income. That also you can offer. So I think that's all for me as of now. So as Aditya announced, sometime in September, we'll have a session that will of course be interactive. Unfortunately, I could not interact with you today on this platform, but yes, definitely I look forward to you interacting to start with online, and the best is face-to-face. Sometime in the future, we'll meet in a physical face-to-face session where we'll have a more lively discussion. So thank you for listening to me for about 1 hour or so, and look forward to meeting you in person. So thank you and take care.